Okay, good morning. We'll just give our attendees a chance to enter our virtual events, but it's wonderful to have you with us. Thank you. I can see the numbers going up. So I'll just give it a brief moment to get everybody into our Zoom forum, and then we'll start with our introduction. A few reminders, and then we'll go straight into our first speaker so he doesn't lose any of his precious time. So I hope everybody has had a successful morning up until this point with minimal stress. And as always, we do appreciate you joining us here for our virtual workshops. We know how busy everybody is at the moment, so we do really appreciate you joining us for this session. It's been a very popular session so far. We've had quite a lot of registration, so we hope to see everybody arrive and benefit from the content. So as you can see on the screen there, this is our virtual protection workshop. So we have a group of our partners who will be presenting some wonderful presentations for you this morning into the afternoon. And then we also have our compliance update as well from Paul Hancox. So we always look forward to our compliance update as well. So we do look forward to quite a lot of content to get through, no doubt. So we'll get things moving and allow the rest of the attendees to join us when they're free. So here's our agenda. We've got a star lineup there, as you can see, lots of interesting subjects and individuals as well who will be speaking today. So 10 a.m. is our first presenter, and that's Chalmers Finn, and I can see Chalmers poised and ready to go. Before we get started with Chalmers, just to let you know, of course, with all webinars that we host, you can't be seen and you cannot be heard, so do not worry. There is a Q&A function within the Zoom forum. So please, if you have got any questions, put them in the Q&A. Our presenters love to answer your questions. And I will pose them to the presenters at the end of their presentations, and then they can answer that for you live, or if they need to take it away and come back to you, then they'll do that. Any problems technically, phone number's there for the broker support desk, give them a call. And of course, your CPD certificate will be sent to you and the email address that you used to register for the event. That's enough of me. So first up, we've got Cirencester Friendly. We've got the wonderful Chalmers, getting your name wrong already. We were talking about Chalmers' name before we started, and I've already got a blooper, so there we go. So we've got Chalmers Finn, who is the business development consultant at Cirencester Friendly. Chalmers, the floor is all yours, my friend.
Fantastic. Thank you, Earl. No problems with the name. As we said, many people get it wrong, so I'm sure I'll have a bit more of that. But yeah, fantastic. Brilliant. Thank you for having me as well. As Earl said, I'm one of the business development consultants at Cirencester Friendly. And I'm going to be talking to you today about income protection, and more specifically about our product, where we can help you guys going forward. And as I said, a bit more detail on our product and income protection. So go through that, and at the end we'll also come on to a bit of claim statistics as well. So we'll go through that in a bit more detail too. Today the product I'm going to be talking to you about is called My Earnings Protected. Now here at Cirencester we do have two. Okay, and I just want to make everyone aware each one involves, okay, and go through that a bit more specifically. Okay, so the other one's called IAE, Income Assured Enhanced. Now, for anyone who's on the webinar today, that one is just for IFA regulated advisors only. So for anyone that does mortgages and protection, this is the product for you. Okay, so just wanted to make that clear, because if you do put an application in through the other one, it's going to get declined. You're going to have to rekey, which is obviously going to be a bit of a pain there. So just to get that one out in the open. Okay. Next slide, please, Earl. Brilliant. So for anyone who doesn't know who we are and a bit more about us, okay, we were established in 1890. Okay, we've been going over 130 years now, and we just do income protection. So hopefully we know what we talk about when it comes to that topic, and we are a bit of a specialist in that area. Okay, so as I said, well established, as you see on the far right, over 44,000 members, which is fantastic. I think that has just grown over to 45,000 members. So We are forever growing, which is great to see as a business. Okay. We are friendly. We are mutual. So we don't have any stakeholders putting money into the business or taking money out. Sorry, Earl, can we go back to the first? That one. There, perfect. Okay. So as I was saying, we are friendly, we are mutual. So we are here for our members, your clients. Okay, that is why we exist. As I mentioned, claim stats at the bottom there, and the awards I'll come on to at the end. I've got a bit more of a specific slide on those. So yeah, let's get into the product a bit more specifically. So next slide, please, Earl. Fantastic. So the feedback that we always get as a company is the product itself is very easy to understand. So hopefully that comes across in today's session and from the start here with our claim periods. Okay, so we offer a short-term 2 years. Okay, so we don't do the 1 year, we don't do a 5 year, we just have that most popular one on the market, that short-term 2 year option there. Okay, we also offer long-term as well until retirement age. Now, for anyone that hasn't used us or has used us before, recently there has been a change there. So we used to just offer ages 65 and 70 with the long term. They now have the option from 55 all the way up until 70 and anything in between. Okay, so a recent change there for the better. So for anyone that hasn't used us or has used us, we have had that change there. So as I say, the claim periods with us, just the short term and the long term option. Okay, next slide, please, Earl. So this is where we're really going to stand out for you guys, okay? Price-wise and what sort of clients we're going to help you. And it's the real key features of our product. So if you take nothing else away from today, this is the most important slide to note down or remember, okay? And it's the fact that we don't load or rate on the premiums across these 3 areas. So the first one being occupation. No matter what it is your client's doing, whether they're sat in front of a computer like we are today, or they're working at heights, manual tradesmen, HGV drivers, you name it, it's not going to make a difference to the premium. Okay, so quite a big area for us there. So that being said, the more riskier the job, the more manual the job, the more likely that we're going to stand out for you price-wise when you're sourcing for us. Okay. Another big one for us, occupation-wise, that we cover is policemen. So that's quite a big one for us in terms of the income protection space. You'll struggle to get many providers that can cover policemen. So the fact that we do that is a big occupation for us. Okay. The second one, hazardous pursuits. So nice and simple, sporting hobbies. Okay, again, so whether they're playing football, rugby, climbing mountains, going on ski holidays, again, you name it, it's not going to make a difference to the premium. Okay, and there's some key and certain sports that we cover as well that you might struggle to find elsewhere. Mixed martial arts, sports like that, again, we're going to cover, and it's not going to affect that premium. Okay. Now, in terms of what we don't cover in the hazardous pursuits, we do exclude land motorized sports. Okay, so quad biking, track events, motocross, that sort of thing, we do exclude. Okay, now if they're just riding a motorbike on a Sunday or to work and back, that is covered. It's just more in a competitive environment. Okay, and again, the only other things to note in terms of the hazardous pursuits is, as long as they haven't had 2 or more accidents in the past 3 years playing that sport, then again, we can cover them. And as long as they're not professional athletes as well. Okay, so if they're semi-professional and earning a small amount of competition money or match day money, we can cover them there, just as long as they're not professional. Okay, and the last one is smoking. So we don't load for smoking. We don't do smoker rates, again, which is another key feature of our product and something that is really going to help when pricing for your clients. Okay, so whether that be vaping, smoking, again, it's not going to make a difference to your client's premium with us. Okay, the one thing to note with the smoking, not that you'll probably come across it very often, but as long as they're not exceeding 39 cigarettes a day, we're going to cover them. So quite a lot there, I am aware, but just something that I have to let you know. Okay, so yeah, those are our real key features. But next slide, please, there, Earl. Brilliant. So a few more of the sort of product features and what's included in the product then, okay. With us premium types, we offer both guaranteed premiums, okay. So first one, guaranteed level, where the price is going to stay the same throughout the duration of the contract, okay. And then we've got our annual escalating, which many of you might have heard of, age costed, okay, where it's going to rise in line with age each year, okay. So both of those premium types are guaranteed premiums as well. Okay, we do also offer indexation, so that is available and that is in line with RPI. Okay, in terms of what we cover, then, guys, we cover up to 65% of the gross annual income, so pretty good when it comes to what we cover there. Okay, a couple of other things to note: client will need to be 18 to get a contract with us, and it will need to be on risk by their 55th birthday, so pretty much 54. Okay. And then lastly there, we've got our deferred periods. So we offer a 1, 4, 8, 13, 26 and 52 week deferred, including your normal split deferred as well. Okay. And those deferred periods are offered across all occupations, all premium types, all claim periods. Okay. There's no differentiating there. They get offered across all of that as well. Okay. Next slide, please, Earl. Fantastic. So we do have some extra benefits that you can add onto the contract for a certain price per month. Okay, we've got 2 of them here. We've got our fraction hospitalization to start with. That is £6 per month. Okay, they would be covered for the 19 listed bones that you can see on our good friend Henry there. They can make 1 claim in any 12-month period. Okay, and it's going to be a £1,500 lump sum payout no matter what the bone is. Okay, so whether it's the ankle, the hip, the knee, it's always going to be a £1,500 payout. Now, what is a really good thing to note about our fracture cover is there's no exclusions on sports. Okay, so when it comes to football, rugby, they're not excluded with our fracture cover. Okay, and as I mentioned, the hospitalization benefit is included as well. So how it works with us is once your client spent 3 consecutive nights in hospital, we'll start to pay out £50 per night, up to 21 nights in total. Okay, and that one is also backdated to day 1 as well. Okay, so a nice little package there. Our fraction hospitalization benefit, as I mentioned, £6 per month. Then we've got our immediate death benefit. Okay, so this is £5 per month. And how it's going to work is, should your client sadly pass away, the named beneficiary is going to receive a lump sum of £7,500. Okay, a nice sum to help with funeral costs, outstanding bills, that sort of thing. Okay. Oops, sorry, Earl, can we go back to the slide before? Brilliant. So yeah, as I was mentioned, the immediate death benefit, lump sum payout, help with funeral costs, that sort of thing. And that will actually be paid out within 3 to 5 days, having us received the death certificate. Okay, so again, a nice early payout there as well. We do actually have one extra add-on that you'll see once you get into the application with us, okay? And it's our day 1 cover. And it's the only way you're going to get day 1 cover. It's called our severe injury cover, sorry. And it's day 1 cover, okay? And it's the only way that you're going to get day 1 cover with us. And how it works is, should they suffer from one of the severe listed injuries, their deferred period will go out the window and they'll be covered from day 1 with us. Okay, so I think there's 8 or 9 of the severe listed injuries. We're talking things such as deep lacerations, fractured bones, brain injuries, that sort of thing. Okay, and if anyone wants to get in touch, I can send the list of those injuries to go in a bit more detail. But as I mentioned, if they're to suffer from one of those injuries and they have this as an add-on, they actually have day 1 cover with us. Okay, so well worth knowing about for those guys that are in higher risk occupations, maybe working at heights, very manual jobs where they're likely to suffer from those injuries. Okay, that's a really good option there. In terms of price with that one, it's all individual. Okay, so it's on an individual basis of each client. The system will give back and quote back a price for that one. So there's no set price for that one. The system will give you that one once you're going through. Okay, so we do have 3 add-ons, as I say, those 2 extra benefits there, and we have our severe injury cover once you go through application as well. Next slide, please, Earl. Fantastic. Okay, so we've got our additional benefits, our added value benefits, as you might see it in the industry. Okay, now these all come included with every contract that's sold with us. Okay, so once your client's contract has gone on risk with us, they have access to all of these benefits. Okay, now I'll talk you through them in a bit more detail. Some of them you may well have come across plenty of times before, but I'll let you know how they work with us here at Cirencester. Okay, so the first one, your halo, is actually just been removed. So I should have taken that off this slide. That was last week. So that's being replaced with something, hopefully, that's going to be used a bit more. We just found that it wasn't being used by our members, your clients, enough. So we're going to replace that. And as I said, being a friendly, being a mutual, it's really important for us that we have these benefits that are actually going to, benefit your clients. Okay, so friendly voice. This one is run by a company called Red Arc. Now, many of you might have come across Red Arc before. A fantastic company that can do so much more than I can explain in my slot. But anything that your client is struggling from, mental health struggles, they can get self-help groups, second medical opinions. That is all involved in the friendly voice. So it's a confidential telephone service with a personalized nurse. And as I mentioned, any of those things that they're struggling with, they can pick up the phone and speak to someone about it. So a fantastic benefit there. Like I said, does so much more than I can go into. The GP24, now pretty standard across most income protection providers now, but how it works with us, all the immediate family have access to this one. Okay, so the partner and the children. It's a 24-hour service, 7 days a week with a qualified GP. Okay, and they can access this via telephone or video appointment. Okay, and they can also access that anywhere in the world. So if they're struggling to get to their GP, there's a long wait time, they're on holiday, etc., they have access to that one. Okay, and they can get 4 consultations a year through the GP24. Okay. Now, the children's critical illness support is a really unique benefit to Cirencester that comes included in the product, as I mentioned. How it works with us is, should your client's child fall ill with a critical illness, we're going to pay out a lump sum of £2,500. Okay, this is to help with any medical bills, any loss of time at work, travel expenses, anything like that. And like I said, that we paid out £2,500 for that support there. Okay. Now, the last couple at the bottom are 125 Foundation. Now, a fantastic foundation that we're so lucky to have on board with us here at Cirencester. There is a case study that you can see there. There's a link. So if these presentations are sent out, there's a link there, but it is also available on our website and our LinkedIn. It's called Anne's Story. Goes into so much detail of a real life story that we had where the 125 Foundation was able to help Anne and her family. Okay. Now, what they basically do is they provide exclusive financial support to deserving causes that need it. They're available there to help out financially with our members and your clients. Okay. So well worth watching that clip. Like I said, goes into a lot more detail on the 125 Foundation. It's a really good sales aid for income protection as well. So feel free to use that one when talking to any of your clients as well. Okay. And the last one there is our members perks. So upon getting a contract with us, your clients will get a login to our website, and it will give them access to all our members perks. Okay, so it's basically a portfolio of money saving discounts on hundreds of brands and different things. Okay, so money off things like Fitbit that you can see there, Apple devices, gym memberships, cinema tickets, restaurants, you name it, it's on there. Okay, so well worth letting your clients know about that one. They can ultimately save hundreds of £100 across the year as well. So a really great additional benefit there as well. Okay. Next slide, please, Earl. So fantastic. So as I mentioned at the start, wanted to talk to you a little bit more in detail about our claim statistics. Okay, really is a USP for us here at Cirencester, something that we want to talk about. Okay, and as you can see in the top left there, The number of paid out claims in 2023 and 2024 was 95.8% of paid out claims. Oh, sorry. There we go. Back. That keeps happening. So yes, 95.8% of claims paid out in 2023 and 2024. So a really, really good statistic there for us here at Cirencester. And one of the reasons that I always like to talk about it, some people might not have heard of Cirencester. Some of your clients, you're always going to have those clients that are a bit skeptical of whether claims are going to be paid out or not. And I think that claim there can give them a little bit of confidence when using Cirencester Friendly. Now, a common question that I then get off the back of that is the 4% that's not being paid out. Why is that? Okay, there's two really big reasons for that that cover pretty much all the 4%, and that's continued income and misrepresentation. Okay, so that pretty much covers that 4% that's not being paid out. Okay, and as you can see there, just underneath, we have maintained an average of 94.5% over the last 10 years. So I'm not just talking to you about the last 2 years because they were great. It's been over a number of years now that we're in those mid-90s, which is fantastic. Okay, now another thing that I just wanted to talk to you about is the top 3 reasons to claim with us here at Cirencester, which is a bit of an interesting stat as well. Okay, and this might be due to the nature of our contract, maybe taking on those higher risk occupations and sporting hobbies. But the top 3 reasons to claim with us are muscular and skeletal, accidents and injuries, and mental health. Now, when it comes to income protection and the other protection policies that are out there, why that's really interesting is because none of those you could make claim on a critical illness or a life insurance, just an income protection. So a really good stat to know about there as well. Okay. And in terms of claims and how it works with us, another one of the questions that I get quite often is, how do you financially underwrite? Okay. We do that at the point of claim. So we financially underwrite at the point of claim. If they're employed, we look at 3 months pay slips. Self-employed will be their latest tax return. Okay. And as I mentioned, that will all be at the point of claim. Okay. Next slide, please. Oh. So underwriting, always a big topic in terms of income protection and when talking to your clients. Okay. We actually have a telephone number there that you can speak to one of our underwriting team. Okay. If you've got any pre-app medicals, instead of keying in that application and maybe getting a decision that you didn't want or having to go back to the client, you can actually talk to one of our underwriting team there and discuss how we can help you or if we'll cover your client. Okay. There's also an email there that you can pop a bit more information in there, and one of our team will get back to you also there. Okay, as well. Now, in terms of underwriting, we are a little bit unique here at Cirencester in terms of some of the things that we cover. Biggest one off the top of my head is type 1 and type 2 diabetics. We actually cover. Okay, so a big, again, USP for us here at Cirencester. There's some other medicals out there that we cover as well that are quite unique. So definitely well worth getting in contact with our underwriting team. Another little point to make you aware of as well is any back or mental health exclusions in the contract that we have to put on there. Your client will actually be offered 5% off the premiums. Okay, so if it's a back exclusion or a mental health exclusion, you're going to get 5%. If for some reason that there is both of those on there, you're going to get 10% off the premiums as well. Okay. Next slide, please, Earl. Brilliant. Okay, so the exact same number that you can see there as well, you'll be able to speak to our advisor services team. So if you've got any contract amendments or you're struggling with any portal issues or anything like that, you can speak to our advisor services team as well there and give them a call, obviously, as well as myself or any of the BDMs that are looking after your firm. Give them a call. They can help you as well. As well, if anyone isn't registered, there is the link there. As I said, if these slides are being sent out to you, which I'm sure they are, you can click on our portal there and get registered with us if that's something that you'd like to do. So hopefully you can do that there as well. But I think that's pretty much it from me, guys, in terms of how we can help you. Hopefully that's given you a bit of more clearer stance on our product, where we can help you, what clients that we're going to suit our product suits with you guys as well. So as I said there, any questions? I think there was one put in there, was there, Earl?
Yeah, there was. So wonderful. Thanks for your presentation. I'm not quite sure the slides were jumping ahead. I promise I'm not guilty. I was enjoying them as much as the rest of us, but yeah, for some reason it kept on jumping ahead. So apologies. Thank you
No
for that.
problem.
There is one question from our friends over at Rapport, and it was, is there a list of illnesses that you can send through? Um, I think it was on one of the slides that you were
Yeah,
mentioning.
so I think that was related to the severe injury cover, the day one cover. I said there's a list
Yeah.
of 8 or 9 injuries there. So yeah, there is a list. I can get them out to them. Oh, I don't know what would be the best way of me being able to get that out. But
Yeah, if you're happy to send it through to me, then I can ping it over to Abby at Rapport, if that's okay.
yeah, fantastic. Yeah, so I'll ping that over to Earl, that list there, and he can send it on from there also.
Wonderful. Thank you. So yeah, really good. Kicked us off nicely there. Some really good points. Key product features, really good.
Yeah,
Noted down some things that you mentioned there. Occupations that you accept, such as policemen. Hazardous pursuits, mixed martial arts is included. No loaded premiums for that. So yeah, really good key features and lots of additional benefits as well for our brokers clients. So thank you so much. Really appreciate it. Look forward to seeing how our other providers compare with what you've presented to us. So thank
no,
you.
thank you very much, Earl. Thanks for having me.
We look forward to having you again. Thanks a lot.
Cheers.
Take care, Chalmers. Okay, so of course we don't end there. We move swiftly on to our next presenter, which is the wonderful Georgia Perkins, and I can see you're ready to go. Hi, Georgia. How are you?
Hi, I'm good, thanks, Earl. How are you?
I'm really good, thank you. Really good.
Good.
So you are from Legal and General, Marketing Development Manager.
Yep.
And I'll
Yeah.
just click through to your next slide, which will give you the theme. And I'll hand over to you if you're ready to go, Georgia.
Fab. Thank you so much. Morning, everybody. I hope everyone's well. My name's Georgia Perkins. I'm the Market Development Manager here at Legal and General. And today I'm going to be looking at how we can have those protection conversations, but really with this angle of leading with income. So, kind of looking at how income can really help drive forward those protection conversations in a different way, but also how it can unlock maybe a bit of a misconception around what clients maybe understand. Do they traditionally think of kind of lump sum benefits as the easiest thing to understand, whilst actually we really want to kind of unlock how leading with income and talking about that income the whole way through can lead to those better outcomes, and it also makes it a little bit more understandable for the clients as well. And how that also protects the lifestyle. So if we go on to the next slide, I'm just going to run through kind of the different areas we're going to look at today. Oh, it's very strange. I wonder why that's come through as pink. It's a bit jazzy for us there. But looking at how mindset really plays a huge part in positioning family income benefit as well as income protection, and how really that those two kind of products and leading with income is the best combination in terms of kind of getting that more bespoke cover for your clients. Also understanding how the various income replacement solutions are used, so creating that bespoke cover for your client's lifestyle, but also bringing in the reason why we want to highlight that is just unlocking a little bit more on what people spend their claims money on to really help bring that conversation to life, make it more relatable to our clients at that point. So let's get started. Next slide, please. And really what we wanted to kind of highlight is, why is it important to lead your discussions with income? And I think it's very key to note that it's the easiest thing for our clients to understand. They know how much money they bring in each month, and they know how much outgoings they've got. Maybe they're not as on it every single month. Maybe they need to always have a bit of a refresher, see what those payments are going out each time. But when we talk in terms of income, it's a lot more understandable around what that income pays for, rather than talking about, say, a lump sum benefit. So if we go on to the next slide, please, what I really wanted to do was kind of showcase how this relates to our clients' life moments. So a very simple graph here on the screen. This is probably a very smooth sailing financial journey for our clients, where they start off on that left-hand side, leaving school, entering the workforce, maybe apprenticeships, university, further education, whatever it might be. But ultimately, they've got quite simple needs in terms of financial goals. It might very much start with just building up a savings pot. Really, maybe then turning that focus as they move through that to getting on the housing ladder. But as we get older and as we move through our careers and we earn more money, those financial goals start to kind of evolve over that point. So moving towards different mortgages, pension contributions, maybe investments. And it maybe at some point they'll then also be in a position where they're inheriting money as well. Now, obviously, that's a smooth sailing graph. It's no roller coasters along the way. But we know that life very much in this sort of accumulation stage can be a bit up and down. We might start new careers, might take time off work, might start businesses. And it's really understanding the importance of the goals that our clients have around this point. And essentially what we know is all of these goals that are kind of noted there within this period are all driven by income and the need to have that. And very much you'll notice that as income fluctuates and it grows, those goals change in line with that. Because if we're being honest, what do we do when we all earn more money? We spend more money. We tend to have maybe more bills going out. It can be as simple as maybe putting in a new kitchen and you're paying that on a monthly basis. It could be getting a bigger house, so your mortgage is bigger. It could be going on more holidays. It could be building out and having more subscriptions that you go every month to watch different TVs. It's all these types of things, but we know that that is by human nature what we do. So we know in terms of income, the more we have, the more we spend, the more responsibilities we have on that, and also our goals change. But in that graph on the right hand side, this is really where the more complex situations kind of comes in from a financial planning point of view. And this is where we retire. We've got that decumulation stage. We're trying to make sure that income lasts for as long as possible. And that's when you start looking at different drawdown pension schemes, investment incomes. Are you becoming bank of family? Are you gifting? Is there an IHT liability? So certainly more complex compared to that accumulation stage where those financial goals are helping us get to that point and retire exactly how we want to. But ultimately, the thing that's going to get us there is protecting our income. So if we move on to the next slide, please, I just want to kind of drill that down a little bit more now. And that's really with this idea around what does that income really cover? What are the responsibilities on that income? And certainly kind of years gone by, the traditional approach with protection was as a very bare minimum, we make sure that the mortgage or the rent is covered. But we know all those goals are still happening. And as we earn more money, we spend more money. And the fact that our income gets spread across even more bills. So it's different expenses, it's childcare, it's also popping into that savings pot to meet that next financial goal. It's maybe wanting to up your pension contributions. And also, just as importantly, ensuring we're still able to look after all those luxuries as well. We certainly know that many, many people need to have that. They're the things that we look forward to outside of our daily working life, are those different luxuries at that point. So we really want to raise that bar and help your clients understand that the income's not just driving the mortgage, it's not just paying for that or the rent, it's paying for all these additional things. And this is why if we lead with income, it's a lot more easier for your clients to understand what that income is paying for, what we're looking to cover, because they know what those bills are each month. So if we just click through, I think it'll just be a couple of clicks on that, really trying to encompass what that income pays for at this point. So if we think about this and go back to that original kind of life moments slide, they were financial goals, all really good to note. Your clients might write a few of those things down, might bring them to life. But what does that actually mean in terms of our day-to-day lives? What are the responsibilities on that income within those financial goals? So if we kind of strip out the financial goals area and have a look at what our money is going towards, it is things like renting whilst we're building up that savings pot. It's focusing on the savings pot to get that mortgage, then we've got all the bills that go alongside the mortgage as well. And then maybe life changes. You maybe start having a family, nursery, school costs, those holidays as well. And when I say holidays, it's the school holidays and having childcare cover within that. Children grow up and we don't really move away from things like nursery school costs either, because we've then got things like the school uniforms. It's the equipment that needs to go alongside that. It's the trips that are included. And then if children are then going on after that, are they going to university? Are you wanting to support them at that point? Maybe also we've had home upgrades along the way. Maybe we've moved a few times, but we've also maybe wanting to make sure that we're covering any form of debt. And also those luxuries, those holidays that are vitally important for us to be able to kind of take that time, recuperate, and live our lives without burnout as well. But ultimately, these are the real moments that a financial goal kind of brings to life. And certainly this is really what we know when we all start asking those questions at the beginning, that sort of fact find, but you're just having that chatty conversation. These will be the types of things that your clients might mention, and really write them down, because these all have a price on them. They all cost money, and we want to ensure that all of these things are still achievable and attainable should anything happen. We want to weather any shocks to our income at that point. Next slide, please. So would be really, really good. I think we've got the chat open here. If anybody's able to, if anyone's quick at maths, maybe asking what our income pays for. So we've got 30 years worth of mortgage payments. If anyone's really, really quick at math, how many mortgage payments are we paying over a 30-year period? And this is what our income is paying for. So just pop it in that chat. It might come through. Is it on the Q&A instead? Might not be there, the functionality, but if we click on to the next one, please. So in terms of over 30 years, the mortgage payments that our income is paying for is, sorry, if you're able just to click on that, is 360 mortgage payments. But as you can see, you've got ahead there. We've also got within that period, 2,400 must pay bills. So that's utilities, your council tax, loans. These are all the bills that there's no way of us being able to get out of. We have to pay these bills without getting into trouble. And that's not the amount per month, it's the number of those bills that go out over that 30-year term. So 360 of them are mortgage payments. On top of that, we have 2,400. And on that basic quality of living costs as well, we've got about, I think it was 1,600 that we also had on there as well. And these are the basic quality of living costs. This includes things like your TV license, your childcare, savings, food doesn't actually fall under the must pay costs there. But all of these things really do add up and take that strain on our income. And if we think of that traditional approach to covering protection, and we're covering those 360 payments by having that lump sum amount that would pay off the mortgage, what do we do in terms of all these other bills that are alongside that as well? And it's getting this across to our clients. We know this, we know that the income is there to derive that, but it's how do we explain this to our clients as well? Next slide, please. And this is really where we want to also drill down on the focus of our protection conversations. And if you haven't already, please do take a look at our risk reality calculator. We've got a bit of an example here on the screen. We've got a lady who is 35 and she's looking to run to a retirement age of 47. You can put her smoker status, she's a non-smoker. And this gives you the statistical chance of something happening. Now, the good thing about this is certainly not to go away and scare anybody, but it's a really good way of being able to shift focus around where those vulnerabilities and the bigger need is. Because we all know traditionally, we all probably will take out that reducing life cover. We know we need that to cover the mortgage. We probably got everyone's buy-in that they'll have to take something like that out. But actually, in this kind of scenario, there's only 3.5% chance of something happening where the client would pass away between now and that retirement age. So really, really low in terms of the risk there. There's an 11.7% chance of suffering a serious or critical illness for her. or there's a 39.4% chance of being unable to work for 1 month or more. The combination risk around that is 41.3%. So when we start looking at things like this and breaking it down, it's all well and good to take out that life cover to cover that mortgage. But actually, it's the ability to earn an income which is going to be more likely to be impacted at this point. So we want to be able to shift our focus in and around that as well. Next slide, please. And this is really where we want to have a look at that holistic advice and protecting the lifestyle, creating a blended approach. And really, you could utilize the language of a protection portfolio. It's mitigating across all those risks there. So having your income protection, maybe some critical illness, some family income benefit, working together as that stronghold with that life insurance there as well. But being able to blend these approaches means that we can create comprehensive income replacement cover. And that's really where I want to shift that focus now. Because when I talk about leading with income, I don't just mean talking about income protection. And certainly when we think of, we've just had IPAW week, we've supported with 3 IPAW sessions in terms of the claims outcome on that. We've got our final session today as well, if you're not already signed up. It's a really, really kind of comprehensive area. We know as an industry that more people need income protection, but I want to highlight another form of income protection, an income replacement in family income benefit as well. So if we move on to the next slide, let's just have a little look here at how we can ask those right questions to give you the knowledge that you need to bring in those different solutions. And this is where I would introduce the what, why. And this is really how we can understand our clients' positions, see where they are on that life moments graph, what's those important goals for them in that moment. But also you're getting the information directly from them. So they're doing the hard work in terms of answering these questions themselves. So number one being the what would you want to happen for your family, you and your home if something was to happen? What's their aspiration around that? What would it look like? What do they want to be? What would they like to leave behind in that scenario at that point? And it's getting them to visualize what would good look like in that moment. Then bringing in the significance of this. So the next what is it about that that's so significant? And you can ask these questions if you've got clients with existing cover as well. So what do you already have in place? What was so significant about that? What do you remember about why you took that out as well? So you have the what, and then that final why is bringing out that meaning. Okay, that's what you would like to happen. I can see that's so significant for you. Why is that so important to you though? And it really helps them bring that out. This is fantastic in terms of avoiding any future objections at all at this point, because you're really utilizing what situation and scenario they would like to play out. What is so significant about that and why is it so important to them? So we can always refer back to that at point. So if there's anything to certainly take away from today's session, the what, why is really, really key. And you'll get a copy of these slides to refer back to as well. So we can bring that out. It might be that they want them to leave the home and that lifestyle intact should anything happen to them. That's significant because currently they're working off 2 incomes to be able to provide for their family. And why is it so important to them? Because their family means everything to them. They don't want to leave them struggling or in a position where they're going to have to make drastic changes in their life, maybe whilst also dealing with the loss of a partner or someone who's going through serious critical illness at that point as well. Next slide, please. So let's have a little look at the different solutions. I'm not going to go into too much product detail here at all. It's really just to highlight how we have these conversations and bring out how leading with income is a fantastic driver for this. In terms of income protection, we have our Design for Everyday income protection benefit. We've also got our low start income protection. So maybe those with that smaller budget, maybe first time buyers, but also not to be ignored is rental clients. They're still paying mortgages. They're still paying all those bills. It's just going to someone else's mortgage at the end of the day. And it's a really good way of being able to start building that relationship up for when they maybe are ready further down the line to get on that housing ladder. And then we also have our executive income protection benefit as well, which really adds that additional USP for yourselves, certainly with those directors and business owners as well. But like I said, this was just one area of protecting income. And this is really that kind of short-term to medium-term solution. That income is going to be looked after if they're unable to work at that point. But I want to bring that to life a bit more with another solution. And this is where we introduce family income benefit as well. Next slide, please. And there's many reasons why family income benefit is certainly one of the most underutilized products in the industry, but one of the most well thought of. And these are sort of 5 reasons to really talk family income protection. Number one, it solves that real problem of monthly income. It's not that lump sum, which you have to essentially try and work out what that would be. Is it 1 year's wage? Is it calculating those different amounts? What sort of lump sum do you come up with? It's actually being able to put a tangible figure on that of how much their income is each month. You can bring it to life in that way, which means it helps the clients understand it immediately. Rather than a lump sum amount, they'll be thinking, okay, well, what's that going to cover? How long would that last me? If they know they're getting that monthly amount, which is the amount of their income or also maybe their outgoings, is immediately understandable. That makes it harder for your advice to be picked apart as well, because many advisors might calculate a lump sum in a different way. This way, it's a very tangible, it's completely and directly linked to what the client earns as well. It fits perfectly alongside income protection by creating a long-term solution as well. And it really shows that you're thinking like an advisor. You're not just taking, an order taker where it's lump sum, lump sum. It's really bringing together to life a more comprehensive solution that really meets the different changing situation that could occur in real life for your clients. And I just want to bring that to life with a bit of a case study for you. But next slide, please, just to kind of really hammer home in terms of family income benefit. Ash Bullen's a business consultant. He has written quite a few articles, one of them being a real strong focus on family income protection. And he quotes that it keeps the lights on, it keeps the fridge full, it keeps the kids in school, and it replaces the paycheck, which is really what matters when someone dies as well. It's also key to note that it's a really strong USP product because, number one, you can't get this on, your clients can't go away and get this on a comparison site. It is completely through the intermediary space, so for yourselves. And also it is flexible because it doesn't have to stay as that monthly income as well. It can be altered to a lump sum should circumstances change. So it offers that flexibility. It also is only underwritten on 2/3 of the overall sum assured at outset. So it gives that a bit of amount if you're in between those kind of medical limits at that point as well. But let's bring it to life on how we can utilize both of these products in a real strong income replacement solution with a live case study. So next slide, please. Sorry, just next slide. So we've got Steve and Fran here. They have a growing family. They're both 35 years old. They have a 4-year-old son, Ben, and Fran is now expecting their second child. They already have decreasing life or critical illness cover in place for the mortgage that you'd previously arranged for them, but you want to discuss income protection with them both now. They're earning that little bit more money. They've moved on since we last spoke about them, and you wanted to get income protection in place the first time round, but we're revisiting it now. So you've run through a full fact find with them and also utilise our budget planner to really get to know their monthly outgoings. So you've got a really good idea of what their essential and non-essential bills are. However, you really need to understand how long they would last without either of their incomes. So we're going to drive that down a little bit more. Next slide, please. And this is a really good idea to be able to kind of draw a timeline out with your client. If you can just click through it, I think it's a couple of clicks just to bring it out. Now, Steve works in construction as a project manager. Fran works in marketing for a small local company. So we really want to look at how long can they cope financially if either are unable to work longer than 6 months. So if we bring up the next details. So now they both get 3 months full sick pay from their employers, which is a really, really strong position to be in. Certainly when we think that there's around 1 in 11, only 1 in 11 clients have actually got any form of income protection. That's personal and group schemes as well. Next click, please. They've also got a savings pot, which could last another month, but they are building that up in preparation for that second child as well. And also noting that that means that they probably going to be falling short of that 6 months kind of goal maybe that we would be looking at. So where do we need to kind of fit that in? Next slide, please. Both of them, after this point, they're going to struggle to pay that. So noting this, they've both agreed to take out £1,750 of IP benefit each for the remaining 30-year term with a 13-week deferment period, £29.87. We've calculated this at around the essential and some non-essential bills each month. So we know that we're covering this area here. That's all well and good. We've got that income protection covered now. They've agreed to take this out. We believe now we've got a really good full suite of protection products in place for them to mitigate against all scenarios. Next slide, please. But 2 years later, Steve is diagnosed with cancer. Now, that original critical illness plan covering the mortgage pays out, and the income protection also starts to pay out while Steve is off work and going through treatment. So they use the income protection money to pay towards essential and non-essential bills that they both contribute to, and they've also got that critical illness money as well. But it's really key to know, what do many people spend that lump sum critical illness money towards? So the CI Expert Critical Thinking report that came out last year, they asked all claimants of critical illness lump sums, what did they spend that money on? And if we just click through to the next slide, we can bring that to life a little bit more. So around 22% of the claimants spent money, either all or part of it, towards private medical treatment. 22%, they helped to replace lost income whilst they couldn't work. So maybe they didn't have that income protection cover in place, so they're having to utilize that to help them. 21% had either part or all of it helped improve or aid their health. 20% use it towards everyday expenses. So Steve would bear in mind that Macmillan Cancer Research actually stated that it costs on average an additional £570 a month to live with cancer. That's getting to and from the hospital for treatment. That's paying for taxis, for parking. That's an increase in your gas and electric bills because you're cold when you go through treatment. It's changing diets. It's so many things, and that is a real strong figure to be able to put on that as well. Now, 20% saved or put all or part of it away for the future, but actually 19%, so the least likely thing to happen, was paying off all or part of the mortgage. And this is the reason why we want to lead with income, because a lot of the time we can utilize the mortgage as the figure that we relate our protection solutions to, being able to put that figure on it. When actually, when we think of things like critical illness, it's the last thing that many clients even think of utilizing that money for. There are many, many other things, such as looking to replace income, changes in their income status, in expenses going up as well. So we know that's the case. So maybe Steve's used that money towards private medical treatment to maybe get ahead on that NHS wait list as well before starting treatment. It could be many, many different things that they use. Or maybe they've been able to save some of it and put it away for the future, not yet ready to make those big financial decisions. But if we go back to the case study now, that we kind of have a better idea of where maybe how that money is going to be utilized. Unfortunately, sadly, Steve's treatment is unsuccessful and he passes away. Steve and Fran bought that house together and had a family together, and that was using both of their salaries. For them to remain in that home is going to take both their salaries. So if we just click on the next animation. The one thing that we know is now changing since Steve's passed away is the fact that his income protection is no longer paying out because he has passed away. They've had the critical illness money through. They might have utilized a lot of that towards private medical treatment, but Fran's now in a position where she only has one income coming in, but still the same house, the same bills. And even if they were to use that money towards paying off the mortgage, how are they paying the rest of those 2,400 must pay bills and those 1,500 non-essential bills as well over that lifetime? How are we covering those things? And this is really where family income protection comes in, is that additional income replacement support. Next slide, please. We really want to help kind of cover that emotional, financial, logistical changes in Fran's life. So we need to help Fran cover those bills. So if they've used a portion of that critical illness money towards the private medical treatment, it doesn't leave much left. So instead, we're looking to take out, if we just click through, some comprehensive family income protection cover, covering the same amount as that income protection, but it's now their income protected beyond death. It can also be a critical illness payout as well, which is another way of maybe making it more affordable rather than a lump sum critical illness as well. But it means that for £21.02 per month, if they were to take this out, they would have been protected short, medium, and long term at this point. If we click through onto the next slide, this is where we're now built out this comprehensive lifestyle cover, this protection portfolio. We've got the short term covered by ensuring that immediate and essential bills are paid with an income protection policy. And we've ran through how long they get covered through work, how long their savings would last, and we've built that within that. Medium term, you've got that critical illness policy there, which allows Steve and Fran to make lifestyle and home changes, provides options for Steve and Fran whilst going through treatment. They maybe don't need to pay off the mortgage. They can use it towards private medical treatment or save it for the future. They're not yet ready to make those decisions, but they have it there. They have the options available to them. But long term, if Steve was not to go through the treatment successfully, as we now know he didn't, we've also got his income protected so that Fran is able to run that family with those two incomes still. She's going through the loss of a partner, but also carrying a family as well. So we know that we've got that long-term solution at this point. Key thing noting that critical illness payment paid out at the beginning. So we also now have got a loss of life cover there. And this really is why these are supporting products. And do you remember that triangle? They all blend together. It's working out how we can make that budget kind of stretch across and mitigate against all those different circumstances. Now, I know we did have a bit of a video, but I know we're short on time and I don't think the video was working very well, but it was just to bring it to life a little bit more. If you want to kind of understand how that family income benefit play out, please do go to our claims portal on our website as well. We have absolutely loads of different claims. These are real life people that we've spoken to, and the family income protection one really helps understand what happens post claim and how this individual, Avril, actually spent the money. For them as a couple, it meant that her husband was able to start a business, so that financial goal was not kind of put off. It didn't leave them in a poor financial state where those aspirations were no longer achievable. It meant they could both take time off work to be together with their family whilst going through sort of diagnosis and treatment for her. So it really helps bring together those different life moments. And I think if that was one thing to really bear in mind, the what, why, bring it back round to what they want to achieve. What does good look like? Why is that so important to them? And this is why this short, medium, and long-term solution really works well, and how leading with income is so much more easier for clients to understand, because it puts a tangible figure that they are in charge of. They have control over every single month of their incomings and outgoings as well. So if I just leave you with one further quote, just to really embed on how leading with income, with family income benefit and income protection is key. If you've been sleeping on IP and family income benefit, now is the time to change that, because when you lead with income, you really do lead with impact, and that's where that real advice begins. So if you do need any help, just to reach out. My name's Georgia Perkins. I'm one of the market development managers. You can follow me on LinkedIn or drop me an email as well. But leading with income really does lead with effective protection solutions, and you're protecting not just the mortgage, but their lifestyle as well. So happy to take any questions if any have come through.
Fantastic. Brilliant, dynamic and passionate delivery there, Georgia. I really appreciate it. Lots of good reminders and new information as well. Some really good quotes and stats within that presentation as well. I think the only question we had was if the slides were going to be available. So you said yes to that. And we also have this recorded as well. So as long as our presenters are happy, this will be made available on our YouTube channel as well for you to watch again. So thank you very much. And again, just to repeat the what, why, great open questions there, really to understand with empathy, I think this slide said, and really get to the heart of what's important to your clients. So thank you so much, Georgia.
No worries. Thank you.
perfect timing, and we move on to our next presenter, which is Greg, or Gregor, should I say, from Royal London. So I can see you ready there, Greg. Thank you very much for stepping forward to our Zoom platform. So you are the Senior Intermediate Development and Technical Manager at Royal London, and the theme of your presentation is on our screen. So over to you, my friend. Thank you very much.
Amazing. Thank you so much, Earl. And yeah, it's a world's longest job title there. So I'm just going to try and share my screen. I'm getting a wee warning saying it's not allowing me to share my screen, but hopefully that will. There we go. Perfect. So just bear with. We'll do a quick tech check. Make sure we're all seeing what I'm seeing. So hopefully what everybody's seeing is a gigantic pelican. Has everybody seen that? Okay.
So yeah, we can see it on the screen. I can see your slides on the left as well. So I don't know if you wanted to, yeah, there we go. Perfect. Thank you, Greg.
Excellent. There we go. Managed to get through all those tech issues in only a few seconds, which is a absolute bonus. But thanks, and thanks George as well, and Chalmers as well to kick us off. Really interesting sessions, and particularly in the family independent stuff, really pertinent and really timely. As I said, my name is Gregor. I'm one of Royal London's senior protection technical managers. I'm going to shift the session today a wee bit. I'm going to move away from focusing on income protection to what I think is another really important topic in the world of protection advice. And that is why you should be fussed about trust, an area that I spend a lot about, probably about 99% of my time at the moment, talking, helping advisors get to grips with. And it's a really important, but also really underutilized area within protection. So we're really going to be talking about trusts. I suppose more importantly, how they should and can form part of the protection advice that you're given. And I know for some on the call today, trust might feel a bit like a no-go topic, but they're actually one of the most powerful tools that we've got at our fingertips to make sure that clients' protection policies actually do what they're intended to do, and probably most importantly, when it's needed most. So over the next 25 or so minutes, I want to walk through some of the key reasons why trusts matter, how to use them. I'm going to try and raise a couple of common challenges that I've heard, and that really is what shaped this session. And hopefully, regardless if you're using trust regularly, if you're just getting started, the session here is going to give you a little nugget or two, and really some practical takeaways, I think, to really bring to life trust with your clients. So as always, I've got a few learning objectives, more so to keep me on the straight and narrow, if nothing else. So firstly, we'll hopefully give you a bit of a better understanding of the role that trusts play in ensuring good protection outcomes. We're going to cover how to know what type of trust to use in different protection planning scenarios. I'm going to pull on one particular case study, which is with joint life policies and whether or not they should be written into trust. And lastly, share some opportunities as to where trusts can actually grow your business. Because done well, trusts are not just a compliance task; they are a real point of difference within advice. And I think I want to start in a slightly different place than just giving some agenda points. I want to bring us to think about some simple questions, and not just simple questions, but I think really powerful questions. I want to imagine that sat across from you is a client, maybe a couple buying their first home, maybe a business owner setting up life cover, and you ask them three questions. So firstly, is it important to you that the people that you want to get the money from that life policy actually get it? Sounds obvious, doesn't it? But without a trust in place and in the absence of a will, there's no guarantee that that will happen. The money could go to somebody else, it might go to an estranged spouse, it could go into a very complicated estate. The second question, is it important to you that they get it quickly? Especially when bills and financial stress hit straight away. Again, common sense, but if the policy falls into a customer's estate, they could be waiting months for probate or confirmation. And in the meantime, mortgage payments, childcare costs, funeral costs, bills all pile up. And finally, the third question, is it important to you that that policy doesn't add to or create a potential inheritance tax liability of up to 40% on the estate? Because if that life policy sits in the estate, it can increase the client's IHT liabilities. And in some cases, especially amongst older clients, maybe business owners, that tax hit can be quite significant. Now, that simple trust that we'll bring to life today can often be just that method of removing that liability in its entirety, or actually removing it from the wider estate. Now, another way to put it, and you might have come across this little analogy, a little phrase in the past, which is right hands, right time, right money. Because when we're framing trusts like that, I think the value of them becomes much clearer, both to clients and hopefully to advisors as well. Right hands, right time, right money. Those are really the outcomes that we're trying to achieve when we're placing life policies into trust. But we are facing a massive trust gap, and it's not a new phenomenon. This trust gap has been around for decades. We commissioned some research back in, I think it was 2023 actually, so it's a few years back now, to try and understand what role trusts play in the protection advice space. What we found was, according to advisors, trusts are becoming more business as usual, which is great to hear. We saw about 8 in 10 advisors saying that they always or sometimes discuss trusts when they're recommending life insurance. Now, great to hear that. The slight conundrum is that that's not necessarily reflected in a correspondingly high rate of life assurance actually assigned into trust. We see generally about 3 in 10 customers falling through with the policy being written into trust. So that gets me thinking of quite a key question: is when somebody's taking out life insurance, they're not just ticking a box, are they? They are doing it with somebody specific in mind. It might be their partner, children, wider family member, I guess a dependent. But the core motivation is almost always the same: is to make sure that if the worst happens, the people they care about are financially looked after, isn't it? That intention is very powerful. That's why people buy life insurance. But I think that intention alone isn't always enough to guarantee that that money is going to get to the right place at the right time. And that is where trusts come in. If we take a little look at the current state of play in the UK when it comes to trusts. So on the left, we've got just over 1.42 million. That's the number of new individual term assurance policies that were sold last year, including critical illness cover. A huge volume of people putting protection in place. Great news. Shifting the attention to the box on the right-hand side, about 23%. So that's the estimated percentage of single-owned life policies currently written in trust. Now, that's not across all protection policies. That is just single life cases, where I would say arguably the case is clearest for a trust to exist. So what that tells us is, for all the progress that we have made, and it is improving, especially when we compare back 5-10 years ago, where that percentage of policies in trust was almost in single figures, we are making improvements to having more policies written in the trust, but we're still a long way from where we need to be. And I guess that prompts the additional questions to, why are we still so far away from where we should be? I'd be interested to see in the chat box, the Q&A box, what are blockers, what are barriers that you've faced when looking at putting life policies into trust? Are there common hurdles that maybe stop that process from being as smooth as it could be? Now, I've run this trust session and training on trust for a few years now. I've pulled together some of the common objections that I've heard from advisors as to why they think, or why they've experienced some certain common blockers when it comes to putting life policies into trust. Now, some are the legal jargon puts the client off, puts the advisor off. Yeah, trusts certainly can sound intimidating when we're looking at words like settler, donor, trustees, beneficiaries. It can often feel quite like legal overkill for a relatively simple policy. Clients often struggle to think of suitable trustees. I think that trustee selection process can be a bit of a pause moment, especially for younger clients, maybe those without close family. I think we can as an industry really help provide those additional thoughts and who trustees should be, and something we'll touch on a little bit later. I don't have time to discuss trust. Totally understandable when we're up against time pressures and targets, but it really is about doing that job thoroughly, making sure that policy does what it's intended to do. It's not really something that's an additional bolt on. It really is a key part to that trust, that policy doing what it's meant to do. It's too complicated to explain to clients. Trust can become quite a complex area, but it doesn't often have to be a great complexity that we're putting out there. It's, I suppose, how do we frame it? Are we starting with using the word trust, or are we framing that language slightly differently? Maybe something as such as, starting with, what would clients want to have happen if the worst happened, very much similar to how George had positioned the income protection discussion earlier. It's a battle getting the trust form to be returned. That's probably a classic one. I think as an industry, we are making big improvements into digital trust completion processes where possible, something that we've implemented recently at Royal London. a common one I've had on over the last couple of months, and particularly probably the last 12 months, if anything, which is I don't have wealthy enough clients. Now, I think this is one of the biggest misconceptions. Trusts are not just for wealthy clients or estate planners. They are about, as I've said before, getting the right money to the right people at the right time. And even a £100,000 life policy could be life-changing. If that has to go through probate, ends up going to the wrong person, that policy is going to be very much undermined. So if we just take a bit of a step back before we go into some of the intricate parts around common questions and barriers, I just want to remind ourselves, what exactly are trusts and what role do they play in financial planning? So taking that very big step back, what exactly is a trust? Well, a trust is, simply put, is a legal arrangement that lets someone, usually the person that's taking out a life policy, pass ownership of that policy to others to look after for the benefit of somebody else. Essentially, it separates the legal ownership from the beneficial ownership. So we've got 3 key roles on screen. We'll break them down. On the left, we've got the settler, sometimes known as the donor. That's the person that's putting the policy into trust. It's the person that's setting up the trust, and it's one that's generally going to be the one that's got the policy against them. So they're putting that policy into trust. Centre bottom, we've got the trustees, the legal owners of that policy. Their job's to look after the policy, crucially make sure that when a claim happens, if a claim happens, then actually the money goes to the right people at the right time. It's a position of quite significant responsibility. As I said before, choosing that trustee is a really important step, but we'll touch on that shortly. And then on the right-hand side, we've got the beneficiaries. So the people or person that are meant to benefit from whatever asset is being put into trust. And then the element of a life policy, then it's going to be the ones that are benefiting from the money from when a claim happens. Often family members, partners, children, but the settler can really name whoever they want to. In the centre, we've got what we've known as a letter of wishes. It's not a legally binding document, but it's a great way to give trustees some guidance on how the donor, the settler, wants the proceeds of that policy to be distributed. It's really useful when we're using discretionary trusts. And again, it's a really good way to give a bit of guidance, and I'll show you how you can use our template letter of wishes towards the end of the session. So in short, settler sets it up, trustees hold the policy, the beneficiaries are the people the client wants to protect and get the benefits from that claim. Now, in the world of trusts, as I said before, they can become quite complex, and I think that certainly is one of the big barriers that I hear a lot. There's a lot of trusts out there, the complexity is a bit of a barrier blocker. There are 2 main types of protection trusts that you're going to come across in the world of protection advice. So hopefully that simplifies things a little bit further. While there's lots of different trusts, the 2 main types that you're going to come across in the world of protection advice are bare and discretionary. Now, I'm not going to dwell too much on the technicalities between each of them, because in reality, at Royal London, we see about 99% of life policies going into a discretionary trust. I'll explain why that is in a moment. But I suppose having a basic distinction of the 2 is quite important. So a bare trust, it's fixed. Once it's set up, the beneficiaries are named, they cannot be changed. Trustees are really just looking after that money until it's passed to those that are named individuals. Simple, predictable, but not flexible. A discretionary trust, on the other hand, gives the trustees more discretion, more control. There's a wide class of potential beneficiaries that can benefit, and the trustees have the decision, the power to decide who gets what, when, and how as well, really. And that means that trust can actually adapt to real world, real life changes. So grandchildren, divorce, beneficiaries become vulnerable. And that's one of the key reasons why we see discretionary trusts almost used universally in protection, because they do offer that flexibility that life doesn't always give us. And as I said, it does give the client and the trustees more control on how those benefits are distributed. If I go back to those 3 roles that we mentioned a moment ago, so the donor, the trustees, and the beneficiaries, I think some of the things that I've often picked up are, what are some of the key things to think about when we're looking at either engaging with those individuals or just as to who those individuals might be. So if we start with the donor, the settler, the putting that life policy into trust, a couple of things just to be aware of. Now, most insurance companies will automatically include the donor as a trustee. It's about giving them some control once the policy has been assigned into trust, so they're not fully out of control as to what's happening there. If you're putting a joint life policy into trust, then both will be donors. And we're going to touch on the letter of wishes a little bit later on, but it's, again, something that's really effective for that donor to be putting into place to give that trustee a bit of guidance on what should happen. Really important is that when we're putting a life policy into trust, it doesn't change the policy in any way. The cover, the premiums still stay the same. It's about impacting and changing who receives the money and how it's paid, but actually the policy itself doesn't change at all. On to the trustees. So probably the most important role here, or at least that can become one of the most important from a responsibility perspective. Firstly, trustees don't need to be professionals. I get this as a common question in our technical mailbox, which is, do we have to always use professionals as a trustee? It's not the case. It can be helpful in certain situations. So for example, if you've got clients that maybe have blended families, having a professional such as a solicitor as a trustee can be quite useful. There does need to be at least 2 trustees named for the trust to operate effectively. So if there's only one donor, at least one additional trustee needs to be named. But on a Royal London Trust form, you can actually name up to an additional 4 trustees. The donor, as I said, are automatically trustees, but what we would still recommend is that even if there are 2 donors, at least one additional trustee is appointed at the outset. And if there's 1 donor, we would recommend that 2 additional trustees are added. And that's because 2 trustees can often be required to pay out a claim in the event of one or both donors dying. There's also another reason as to why that's the case, and I'll touch on that in a moment. We do strongly recommend that at least one of the trustees is independent, so somebody that is not a discretionary beneficiary or the donor of the trust. Trustees do need to be at least 18 in England or 16 in Scotland. From our perspective, we need to see the full names, including any middle names, addresses of each of the additional trustees that are being named. And I suppose it's another obvious one, but they do need to be made aware that they are being a trustee. At least they're notified that that role is being put upon them. Again, a question I get quite a lot is, can you have overseas trustees? You absolutely can have overseas trustees. Something to bear in mind is, from an administrative perspective, how easy is it for them to act as a trustee if they are overseas? If they're dealing with multiple time zones, it can make administration a bit more tiresome, a bit more cumbersome. And at the bottom there, that other reason why it's quite useful to have at least 3 trustees is because it is, on Royal London Trusts, essential that all trustees act together, and any decisions that they make have to be made and agreed as a majority. So if you have 2 trustees, you do run the risk of decisions not being agreed by a majority, a bit of a stalemate. If you've got 3 trustees, then you are reducing that risk of decisions not being met by majority. So just a little tip there from myself. From a beneficiary perspective, again, might seem like an obvious statement to make, but the donor must not be named as a beneficiary, otherwise that trust is going to fail. If it means the benefits of the trust are going to go back into the estate of the donor, it's not going to work. If you've got a bare trust, the beneficiaries do need to be named at outset. As we've touched on before, bare trusts do not offer any flexibility, so any named beneficiaries cannot be changed later on. Discretionary trusts do give that level of flexibility, so the trustees can choose who receives the benefits from of the policy from a list of potential beneficiaries, and I'll cover that shortly. Any beneficiaries can be a trustee as well. Something just to be aware of. Again, another question that I get quite a lot. As long as they're over the age of 18 and they do act impartially, they can be a trustee. One of the questions that I've had quite a lot over the last couple of weeks from running the session is what happens if there's children under the age of 18? Who controls the money? I've had that a lot over the last couple of weeks, but in reality, it's a very common question. The answer to that really depends on the type of trust. If you have a bare trust, the children would be the absolute beneficiaries. So for example, if I set up a bare trust for my 2-year-old son, I'll put my wife as the sole trustee. If I die when my son is, let's say, 5, Royal London would pay the death benefits to my wife as the trustee. She would manage the fund for her son until he's 18, and any money left would be paid out to him at that point. With a discretionary trust, there's nobody that's entitled to the benefits until the trustees make the appointment to them. So while my son would be classed as a potential beneficiary, he might only get the death benefits when the trustees decide to pay him. That might not be aged 18, that could be 25, could be beyond that. And that's where that letter of wishes is really impactful, because it gives the trustees that guidance to know, well, I would like my son to be paid out at X or Y age. Again, the real importance of having that letter of wishes. Now, with that potential list of beneficiaries, most insurers have a fairly standard list of potential beneficiaries within a discretionary trust. Some can be very different, but generally follow a very similar format. And it's a way to give trustees, again, a lot of control over who should get who, what, and when. So good for flexibility when we're using discretionary trusts, but it does also mean we do need to be clear about who those potential beneficiaries are. And that's where this default list really comes in handy. So it's there to say that the trustees can only distribute the funds from that policy, from the trust, to the people that are named on that list. So at Royal London, we include within our list quite a broad range. So spouses, civil partners, children, grandchildren, future descendants, charities, etc. The idea here is really to try and cover life's major relationships without needing to update the trust every time something changes. So, for example, if a child marries or if the family grows. The important thing is that if somebody wants to name somebody that's not within that list, then, for example, it could be a close friend, an unmarried partner, a protection technical presenter, whoever it is, then they do need to be named in writing again on that from the screenshot on screen from our own discretionary trust form. There's a couple of blank boxes on the trust form that any additional people could be named on. So again, it's about giving trustees a bit of support as to individuals to pay those benefits out to. On the right-hand side, I've referenced modern family structures. There is a reason behind this. Now, there's a growing number of people across the country living together in cohabiting couples, so living together regardless if they have children or not, and not married. That number is on the rise. And of course, the law doesn't offer the same protections for non-married couples as it does for married couples. Now, in an industry first, about 2 years ago now, Royal London added cohabitees into our discretionary beneficiary list. So what that means is that cohabiting partners can now be named by trustees to receive trust benefits if they've not been specifically named. So just something I thought I'd bring to life. I'm trying to pull some of the common questions that I get a lot, and one of the ones I get maybe more than any is, can joint life policies be written into trust? Or more, you put it in a different way, is, should joint life policies be written into trust? Because I think one of the trickier legal quirks that I don't think gets enough airtime in the protection advice space is what happens if both life assureds and a joint life policy die at the same time, or if they die close together in such a way that it means we can't actually tell who died first. So I suppose what we see is this not just a theoretical point to make. Car accidents, house fires, travel incidents do often result in simultaneous deaths. And if there's no clear order of death, then the law in each part of the UK would then step in to decide who died first. Now that matters because on a joint life first death policy, only that first death is going to trigger the payout. So that common question as I get it is, should a joint life policy into trust? Now, on the face of it, a joint life first death policy, for example, to repay a mortgage debt, might not always seem like it needs a trust. After all, if it's a couple, they're joint owners. If one dies, the money pays out to the survivor, right? So when we're deciding whether or not to put a joint life policy into trust, there are two big questions to think about. So firstly, are the clients married or in a civil partnership? If they are, on first death, there's no inheritance tax thanks to the spousal exemption. If they're not, then half of that payout is treated as if it's been transferred from the deceased to the survivor. Now, that transfer could be taxed at 40%, depends on the value of the policy, the rest of the deceased's estate. The second question is, what if they die at the same time or within a few days of each other? Now, if it's impossible to determine who died first, under English and Welsh law, the younger person will have been treated as dying first, as having died last. Now, what that means is that all of the proceeds could pass to their estate only. It might cut out the older person's family entirely. And if one survives the other by a short period of time, then that payout moves between those two estates. And that could create a few issues, particularly around probate and IHT calculations. Now, there are ways to prevent the impact of those events happening, and that is to use a trust that includes what's known as a survivorship clause. Because what that trust does, where there is a survivorship clause within it, it removes the policy from both estates unless one survives by at least 30 days. So if one person does survive by 30 days, the payout goes to them via the trust. No probate, no IHT, even if they're unmarried. Now, if neither survive by 30 days, the money stays in trust for the other beneficiaries. Again, no probate or IHT, but if it's a discretionary trust, it's worth just point out that the relevant property charges and relevant property regime may apply, but again, it's a way of making sure that the wishes that are met if they both die within a short space of time. If we're not using a trust, so if there's no trust, all of those complications could kick in. If it's a joint life policy, the surviving client, their heirs might inherit everything, potentially excluding the others unintentionally. So again, just something to bear in mind, and really the reason that we always recommend with joint life policies that they are put into trusts, that you have that survivorship clause within it. We've got a lot of literature that can help support this. It's hard to cover that off in a 30-minute slot, but again, I'll leave my details if you want to go into this in a little bit further detail after the session today. So a little bit of a look at the benefits of a trust. Now I'm going to quickly touch on something else, an alternative option. Because trusts are fantastic, they're excellent, they're great, they've got a really powerful role in financial planning, but they might not always be the best option. Particularly for younger clients, maybe single people, or those with simpler financial arrangements, a trust might feel like a bit more of a barrier to getting cover in place. Now, when we're arranging money, or when we're arranging policies for clients, I suppose one of the most important and often overlooked questions is, where's the money going to go? Who gets the payout, and how quickly can they access it? So generally, there's three very well-known routes to where money from a policy goes. It goes into the estate. If it's not written into trust, it'll go into an estate. Of course, we've got trusts. Again, what we've looked at in a bit of detail today, takes the policy out of the estate, voids probate confirmation, and gets the funds to the right people. Life of another, a very effective route as well. Again, it can be a good alternative to a trust. It can help avoid probate delays and inheritance tax for that one beneficiary. Significant downside with this is that compared to a trust, life of another means that a third party, the life of another owner, holds the policy. So if that relationship sours, divorce, dissolution of a civil partnership, the ownership and payout are completely in that person's hands. There is a fourth option. Now, this has become a little bit more of a popular option over the last few years. There's about 4 other insurers that I'm aware of that offer this option, and it's called beneficiary nomination or contractual beneficiary nomination. So it's a relatively new contender. From a Royal London perspective, contractual beneficiary nomination is available on single life or CI or whole of life policies. It's available during the application only. But during the application only, if nomination of beneficiaries is selected, clients can name up to 5 individuals that they want to receive the death benefits from that policy if a death claim happens. If it's a critical illness claim, the policy, the benefits are paid to they're paid to the policy owner. The benefits of using beneficiary nomination are it's much simpler. It's all done fully online. There's no trustees needed. It follows contract law. It keeps the benefits the death benefits out of the estate. The clients still have control over who those beneficiaries are. They can change those beneficiaries at any point in time. And it's a really good stopgap as well if a trust might be looked at, if a trust is going to be set up in the future, but maybe not right now. Beneficiary nomination can be a really good stopgap to provide that protection until that trust is put in place. Trusts absolutely still have their role if you've got more complex cases. Joint life policies, if there's a need for maybe more long-term inheritance tax planning, then trusts are a fantastic route to go down. But for many simpler situations and cases, beneficiary nominations are a really, really good alternative to use. Just a couple of things to finish up on in the last few minutes. So the benefits to bring in trusts and beneficiary nomination to life, I think it really presents a higher quality advice, particularly when we look at how few life policies are actually written into trust. It can help stand out. Opens up review opportunities when we're looking at letters of wishes, maybe referral opportunities to engage with trustees. Helps keep the business on the books for longer, persistency rates, and I think actually from a consumer duty perspective, it really does go a long way to helping achieve those good customer outcomes. On our advised website, we do have a template letter of wishes that you're more than welcome to use. As I said at the start, it's not a legally bound document, but it's a really good way just to give the trustees some guidance on what the donor wants to do or wants to have happen with the policy on claim. I'm often asked the questions of why wouldn't you just put all of this in a will? Well, remember, when we're putting a life policy into trust, that removes it from the estate, so it's actually not governed by a will. And a trustee doesn't have to take into account what it states within a will. They also don't have to take into account what's stated in a letter of wishes. It would be odd if they didn't, but they are not legally bound to follow a letter of wishes, but a very effective tool to have when we're looking at discretionary trusts. The last thing I'll share with you, one of the last things, is just a very simple little sales idea. We're struggling to get across that point of having the need for the trust. if we've got a little trust disclaimer here, hopefully just re-emphasizes the implications of not having that like policy into trust and actually just getting customers to sign it. And it might be that point in time where they think, actually, you know what, let's take that trust conversation a bit further. And actually, from your perspective, it helps evidence that the conversation of the trust beneficial nomination happened in the first instance. And I suppose it's that the point of, if we were presented with that disclaimer ourselves, would we really sign it, or would we review the conversation? So a lot of things from Earl, and then we can help you with. We have a trust decision tree that will always guarantee that you use the right trust in every scenario. We can send that out after the session. We've got a lot of literature that can help you have those trust conversations with trustees and clients as well. We've got a fully online trust process, and we've got a suite of in-house support that can help you have these thorough trust conversations. And again, myself and our wider technical team can help you have these conversations in more detail from today's session. So I'll pass back across to yourself, Earl. I'll leave you with our advisor website. It's advisor.roland.com/protection. A lot of nuggets in there, hopefully, but hopefully just giving that idea as to why trusts play a really vital role in the world of protection plans. So, Earl, I'll pass back over to you. Thank you so much.
Thank you. That was very interesting, and you provided a lot of clarity on trust there. I'm sure our brokers and financial advisors are a lot more clued up than me, but I certainly learned something new there. And there is a question, actually, if I can put that to you just very briefly because of the time. Not sure if you can still see it on your screen.
Oh, I'm back now. Sorry, my internet decided to kick out right at the last minute.
Yeah, I noticed you went, yeah, a bit funny. Yeah, so there was a question from Des Richards in our Q&A, and he just said, if it's a critical illness plan, won't the CI benefit the donor by using a split trust?
Absolutely, yeah. So critical illness, if you're setting up a critical illness policy, then split trusts are a good way to make sure that the CI benefit is passed to the individual that needs to benefit from it. Just something to be aware of with the Royal London Discretionary Trust. We actually only have one discretionary trust, but it does cater for those scenarios where you do need that split trust, or you do need that survivorship clause. That is already factored into our discretionary trust form. So there's no need to have additional trusts. It's all catered within that Royal London Discretionary Trust. But yeah, for kick benefits, the one thing you do want to factor in is making sure that that benefit will be split.
Brilliant. So there we go. Hope that answers your question there, Des. Thank you for putting that in the Q&A. We appreciate it. And again, thank you, Gregor. Really appreciate your time. Thank you for spending that with us. And again, we look forward to meeting up with you again at some point in the future.
Thanks,
Thank you.
Thanks,
so I'll just see if I can share my screen again as we change direction only very slightly. And we move over to our compliance section of our morning and afternoon. And I can see Paul Hancox is ready and raring to go there. Hi, Paul. Welcome to the event. Thank you for joining us. Paul Hancox is Head of Advice Support within the group. Hopefully you can see that on your screens currently. Can you see your presentation, Paul?
Yeah, I can see a title slide, Earl. Yeah, is the next slide there?
Perfect. Over to you. Thank you.
Yeah, morning, Earl. Morning, everyone. So just a bit about me. So I've worked now at Primus for 18 months. Prior to joining Primus, I worked for a lender where I spent most of my career in kind of sales and operations. So my most recent role was head of customer contact, where I led all of the customer-facing teams. So as a result, I totally understand the challenge of having to meet customer needs, balancing consumer duty outcomes while ticking all of the compliance boxes. I know it isn't easy, and I felt the frustration when feedback from compliance functions delivered poorly, particularly when you're really passionate about getting it right and delivering a good customer outcome. So my aim in my role at Primus is to facilitate a partnership between advice support team, or AST as we're known, and our ARs, and to build trust so they know that we are doing our utmost to protect them and the network. Next slide, please. So what I intend to cover today is our approach to case selection and certain triggers that would direct AST to review a file and then look at some common trends and issues. I'll focus on addendums and mortgage and protection outcomes, and then briefly look at a couple of areas of interest for the FCA, and then some best practice principles. Next slide. So File reviews aim to ensure that the principles of consumer duties are being achieved by focusing on ensuring customers are receiving good outcomes. So we in AST, we aim to ensure that advice is suitable, reflects demands and needs. Customers fully appreciate the features, the risks, the limitations, and the costs of the products they purchase. Customers with vulnerable characteristics receive good outcomes, and that fees and commissions reflect fair value. So at present, we only complete full advice checks, and case records must demonstrate that the advisor has made a recommendation to meet the needs and circumstances of the customer to attract a suitable outcome. Next slide. It's a bit of a busy slide, so I'll kind of break this down. So advice support, we apply a risk-based approach for cases selected for review. But there are kind of several prompts or triggers that guide advice support to review a file. So overall, we aim to check 10% of all submitted files. So we check about 2,500 reviews, or sorry, we review about 2,500 files each month. And it's kind of made up of the following. So 25% of all the files that we look at, we classify as being high risk products, which essentially means that there's a higher propensity for a poor customer outcome. So for example, bridging cases, replacement, terms going past standard retirement age, debt con, those kind of cases. We also check a number of cases depending on the licenses held by an advisor. So if you've got a mortgage license, we will check a minimum of one mortgage case every 6 months. And then there are AR triggers, which will guide us to check a case. So if certain indicators spike, so if a persistency rating dip, if a firm changes their business model, so if they become a telesales firm, if we see increasing rates of complaints, or if business volumes significantly increase, we will check cases for those triggers, for those indicators. Next slide, please. So yeah, I wanted to share with you an understanding of current file standards. So year to date, and this is up till the end of August, we've completed over 17,000 reviews. A file will then attract one in 4 potential outcomes. So it'll be either rated suitable, where there are no concerns with the file or how it's presented, suitable with development, which is just where minor amendments are required just for the completeness of the file. And just about 60% of all the files that we review attract one of these 2 outcomes. So they're really well presented. The fact find clearly captures the customer's demands and needs, and there are no particular concerns with sourcing, and the advice sits within network expectations and is well summarized in the rec letter. About 40% of files then attract a missing information grade. So this is essentially advice support stating that we don't know what you've done or why you've done it, essentially. Picking up the file cold, it doesn't give us confidence that the customer is in a fully informed position. Now, probably on a positive note, on most occasions, a good customer outcome has been achieved, but we've had to reach out for the advisor for further information in order for the file to tell that story. And then we have about 3% of these files that trip over into an unsuitable outcome, where we feel a good customer outcome has not been achieved, where essentially the advice doesn't meet the needs of the customer, or potentially the advisor has given advice in an area is not authorized. Now these, to be fair, are few and far between, or the advice does not demonstrate that a good customer outcome has been achieved. And probably what I really wanted to highlight here is that of the 17,000 reviews, kind of just over 11,000 of them were completed for protection files. And from the table, you can see that 515 outcomes, or 92% of all our unsuitable outcomes are produced by protection files. So generally, as a rule, mortgage files tend to be of good standard, and it's protection files where advisors probably need to spend a little bit more time ensuring that the file truly tells a story and meets the customer's objectives. Next slide, please. So I specifically want to kind of call out addendums, as this is probably a bone of contention internally for Primis, which is that really the number of addendums that we request, as the original rec letter on file is not deemed to be suitable, kind of causes us some concerns. And these are generally requested on the back of an missing information grade. So you will know that a consumer-focused rec letter aims to communicate advice in a clear and concise manner, ensuring that the clients comprehend the recommendations being made. So these reports should include a summary of the advice provided, the client's goals, objectives, the risks, any associated risks and benefits, and the rationale behind the recommendation. Now, advice support will request an addendum where key information is missing, as we fear that this missing information could easily play a part in making it kind of difficult for us to defend a complaint, or to justify how we've met our consumer duty responsibilities around customer understanding. Now, we work with our brokers and reduce that number of addendums that we request from kind of 1 in 5 cases to 1 in 7, 1 in 8. But this is still too high. And probably to avoid this trap, the areas we encourage our advisors to focus on are really around probably 2 or 3 areas. But one, where sourcing would kind of highlight or dictate that a cheaper provider has not been recommended. And really to ensure that the fact finder has got to tell that story as to why and how that's replayed in the rec letter. We find that rec letters frequently exclude risk warnings. So, for example, we're seeing an increasing number of cases now that are moving past standard retirement age, but the rec letters don't really include the recommended or the required risk warnings to make that real, that need and that concern clear to the customer. And we'd see insufficient explanation of why maybe a limited solution such as short-term income protection was judged to be the best to meet the customer demands and needs, and reasons why full income protection were discounted. These weren't being recorded. Next slide, please. So with mortgage files, we'll have a look at the trends that we see within these files. The most common reason for a kind of a mortgage file that would attract a missing information grade generally falls into 2 camps. Generally, mortgage file, the advice is sound, but it just doesn't really tell the whole story, and they're just often points that need clarifying. So this tends to be where ERCs are being paid, but the file doesn't cover why porting has been discounted. The source of the deposit is unclear. The customer's budget has not been fully utilised, so we'll ask for confirmation if we feel that the term of the mortgage could have been reduced by a year or more. Lending past and the retirement age, as mentioned, is becoming increasingly common. The file must demonstrate how the mortgage commitment will then be maintained. And bank statements frequently highlight commitments that have not been disclosed in the fact find, and we feel potentially affordability could have been impacted. This is a point that would be raised. And then just making sure rec letters if the appropriate risk warnings are missing. So unsuitable outcomes for mortgages for mortgage files are few and far between. However, the trends fall into 2 distinct camps. So potentially 50% tend to be as a result of administration areas, as opposed to the advice not meeting the customer's objectives. So for example, simply the wrong product has been selected by the advisor. And where we feel the advice is a concern, so the second area tends to relate to debt con cases, where we see a number of files that don't reflect primary guidance. So, these would include when we're kind of consolidating loans with less than 12 months left to run, credit cards on 0% interest payments, or really the justification for debt con is simply not robust, particularly if all commitments, fall well within affordability. So the rules I'm sure you're all aware is, ensure your file tells a story, where it's possible, using the customer's own words. Next file, please. Protection. So 1 in 50 protection files currently attract an unsuitable outcome. So 2 in every 100. And this tends to result from at least 50% of unsuitable outcomes result from poor administration created when data is transposed from one platform to another, which then creates errors, for example, in the incorrect term or date of birth or the sum assured. And there's a number of reasons why advice may be graded as unsuitable, and I'll pick those up on the next slide. However, regardless of whether it's administration or advice, they both have the potential to lead to a poor customer outcome. Next slide. So these are the regular common trends that we see within protection files, where the advice has the potential to lead to a poor outcome. So a fixed term assurance policy has been recommended when a whole of life policy is more appropriate, and this has not been considered evidence within the file. Single policies sold to protect a joint decrease in term where there are no extenuating circumstances. So, for example, potentially if one of the clients has a medical condition. Insufficient justification for replacement business, so like-for-like replacements, or even when a policy is replaced and the advisor has no understanding of the terms and conditions of the current policy. Product choice, so for example, if the demands and needs for the customer, if the guaranteed repayment of that mortgage commitment, and then maybe a product like Vitality Sick One's been recommended, that's probably unlikely to meet the customer's needs. LTAs to cover a decrease in mortgage where a host of other potential kind of needs been identified, and this kind of then leads into wealth creation, and then incorrect amounts for deferred periods for income protection, and this is probably a growing and increasing trend that we're trying to really support our advisors with. Next slide. So just a couple of areas probably to call out. These probably aren't that new, probably towards the kind of came towards the start of this year, but the FCA are very interested in replacements, and this is specifically called out in the FCA's protection review. So they're concerned that advisors may be causing harm to clients when they transact in this area, when replacement business may be driven by the advisor's agenda as opposed to customer need. So for example, let's move everything from Aviva to L&G in 1 year based on a small policy feature, or at the end of the indemnity period where a large number of policies are kind of suddenly switched. And this suggests that the indemnity period is the trigger rather than a change in client need. And our worst and most difficult and expensive complaints generally relate to switches that have gone wrong. For example, not recognising health changes in new applications, or properly considering whether cover has reduced. And we've recently paid out kind of 55k to a client where an existing policy had been cancelled without a new policy going on risk. Probably the reality was the old policy would have met the need, but the new one wouldn't. So we ask all advisors, and make it really important to ask all of the medical and lifestyle questions as worded on the provider application, not rely on generic questions from previous completion. Second area is kind of target market. So the FCA rule book already exists detailing the target market for each product. Over last year, the FCA completed a thematic review involving over 90 providers and distributor firms, and they're probably not really happy with the outcomes. This led to issuing new guidance and specific requests for change. So they found the generic target statements as quite broad, really, and understandably they want target market statements to be more granular. So we're now in the process of weaving target market feedback into our file review feedback. And probably the key point here is to know and to keep within your target. Outside of is a report or alert to the provider, and can have consequences that can include the need to contact the clients and to review the advice that's been provided. Next slide. So I guess rarely will achieving all compliance expectations be easy, but there are probably some simple steps that all firms can adopt to deliver improved outcomes. The challenge is not to deliver a great customer experience and fall foul because your file or admin doesn't back this up. Our most compliant firms, if you like, those that regularly attract suitable outcomes, probably have adopted some really simple, straightforward processes, feedback, and put processes in place to ensure that the same mistakes aren't repeated. But they share these learnings across the firm, so they learn from one another. They have a 4 eyes check to reduce the admin outcomes that can lead to poor grades. And really important, the really good firms really develop their admin teams to a really high standard. They use our internal checklists and rec letters. They have consequences for things go wrong. And importantly, they just allow sufficient time to the administration of each file. Next slide. I think that's the last one. Yeah, thank you.
Thank you very much. Sorry I couldn't find a button to get my face back on the screen there. Not that anybody wants to see. But thank you very much. Really good. And you mentioned Primis there as well as that. So Paul's team look after Primis and TMA brokers as well. So I guess the main difference with what you do for the DA brokers is you provide them with that guidance and suggestions of how they can improve their files to make them regulatory.
Yeah, so we assess their files against Primis standards, but what we don't do is grade those files because that probably wouldn't seem fair. But we give feedback and suggest remedial points as we would do if we were dealing with a Primis advisor. Oh, yeah, that's correct.
Cool. And we certainly will be paying out 55k for the errors of one of our brokers. That will be on you guys. As in brokers. I'm on joking there. But if any of you who are listening in today don't currently use TMA as a support service for your compliance, then please do reach out to your key account managers and allow them to discuss what options are available. So there's several different contract types, and you can by specific services. So it could just be file checks, which the advice support team will help you to go through and check, or it might be other levels of service as well. But if you haven't had a conversation with your key account manager at TMA, please do, or reach out to my team on the broker support desk, and then we can point you in the direction of who you need to speak to. So wonderful. I'll just check if there's any questions. I don't think there were any during the presentation. I can see something there at the moment. Let's have a quick look. Oh no, that's just somebody saying thank you. Thank you too. Right, so our next presenter, I think he's just fallen off of our panel, so we're just trying to get him back. So we'll say thank you to you, Paul, and if you just bear with us for a brief moment, to all of our delegates, we'll just reach out to our next presenter, who you can see on screen there is Carl Hurd. And the wonderful team in the background are just trying to get in touch with him for us. So if you have got any other questions, just whilst we're waiting, if you can pop them in the Q&A, and then we can get them presented to any of the speakers that you've missed an opportunity to ask the question to, and then we can get them over to them to answer for you. But it's been a great session so far. Hope you've enjoyed it and are enjoying it. Like I say, don't go anywhere. We're just trying to get Carl back on. There might have been a technical fault that caused him to fall off. And just to fill the gap, if you haven't already, you may know we've got our annual conference taking place on the 27th of November. So time is fast approaching for that. So if you haven't already registered, please do. You can do so via the email you most likely would have received already. You can register for the event, the main event, and also the new feature we've got this year with 12 breakout rooms with specific discussions, sessions, panel discussions, presentations on AI and such like things. So it's going to be a pretty dynamic and fast-moving event this year. But if you haven't registered, as mentioned, do so through the email you've received or through TMA website as well, which is tmaclub.com, which one of my wonderful team members just emailed me on. So thank you, Heather. So if you want to log on or to visit our website, please do so. There's a banner on the home screen to do that. You are more than welcome to attend, and we look forward to seeing you there. So if you just bear with me for a brief moment, just while I quickly check a message from my colleague Leah, bear with me. Okay, so we haven't managed to reach him just yet, and I'm certainly not going to try to imitate the national account manager of LV and go through his presentation. So if you can hang fire, don't go anywhere. I'll just switch off my mic for a moment and see if we can help Carl with his technical issue. So bear with us. I've got no intermission music, so speak amongst yourselves in your own offices. Bear with me. Thank you for bearing with us. We're just trying to get Carl on through his mobile phone. There seems to be a technical issue with his laptop. So thank you for your patience, everybody. Just give us a moment or two. Ah, hello, Carl. Can you hear us okay?
Hello. I can, yeah. Sorry, apologies for that. Managed to lose my internet at about 20 to 12. So been running around trying to set the router and everything else, and it's not working. So we're on 4G, but I'm here. So, you know,
well done, well done.
We'll give it a go.
Don't worry, you gave me an
I've got a
opportunity
bit of an odd
to
view is the only thing, but I don't think, Earl, are you controlling the slides? Because I can't see the controls from here now. Is that right?
yes, I'll control the slides for you. So yeah, if you want to kick off, we'll go straight into it. To be fair, our last presenter finished just slightly early, so you're still within time. You've got your full 30 minutes if you need it, so no need to speak quicker than usual.
All right.
You can be your calm, composed self, Carl. Over to you. Thank you for rejoining us. We really appreciate that. And thanks for everybody for holding on and not disappearing. But Carl, there you are, National Account Manager of LV. Over to you.
Cheers. Thank you, Earl. Thank you. So yeah, apologies everybody. So we'll get our way through this. One is a technology. After all this time, we'd think it would be fine, wouldn't it? But there we are. So you heard a lot about income protection and protecting income today from a lot of my colleagues earlier on. A similar thing that I'm going to be talking about today. I'm going to lean a little bit more towards income protection and actually relating that to families themselves. So Earl, if you can click on for me, please. So I'm going to be looking at how families can understand their need for protecting their income. Give a bit of a flavour, bit more of a flavour, refresher, if you like, of our income protection plan, and talk about how the features of that can actually be tailored towards the advice you give to families. I'll touch on family income benefit. Well aware Georgia touched on this earlier on, but I'll do a little bit of that as well. And then let's talk a little bit about some of the added services that come with the products as well, and just a reminder there again of how good they could be for your client and their family as well. So when we're talking about reminders and refreshers, very quick one on this one. If you've seen me present before, you know that I talk about this all the time. But I do because I'm passionate about it, and I think it's a great tool to use when you're talking to clients about protecting income. And that is primarily our risk reality calculator. If you're going to talk about different types of protection, so not just term assurance and life insurance, but actually broadening that to critical illness and especially talking about income, then please do look at using a risk tool. It's a really great way of positioning that with clients. The LV one is the original, the best. I'm bound to say that. I am sponsored by LV, but we have had that out. It's the first risk tool that came into the UK. We've kept it pretty simple since we first launched it, in the fact that it's usable with a client directly, and the client can actually go on the website themselves and use it. So please do have a look at that and play about with that. It's a great way of starting the conversation about protection, and it's a great way of bringing protection right at the beginning of your conversation and interactions with the client. So if you're on a mortgage journey with your client, it's a really great way of saying, along this journey of arranging your mortgage or remortgaging, whatever it might be, we'll talk about protection. And using the risk tool, you can put that right to the beginning, get them thinking about protection. It doesn't have any product solutions, doesn't get them thinking about specific products. It's all about the risks, first of all. And then there's lots of other tools we use. Again, if you're talking about income protection, we have an income shortfall calculator, and a split deferred period calculator as well. So next one, please, Earl. And next one again, please. So from an LV perspective, if you know us well enough, you'll know that we actually offer 3 different income protection products. The first one is our primary, I guess you'd want to call it standard income protection product. It's a lot more than standard, but it's your traditional income protection product. And I'm going to touch on that in a moment. But don't forget, within our income protection family, we also have our personal sick pay plan, which is geared a bit more towards the self-employed. And then we also have executive income protection plan as well. We're one of only 2 providers actually in that space. So if you're looking at business protection and specifically exec income protection, then we have that as well. So let's start with and hover a moment on our full income protection plan. So when we're talking about families here, I want to draw out some of the features that come with that income protection plan that really do relate to a family. Now, with our income protection plan, we also have fracture cover. That's more about the individual. So that's there. It's still on there as a feature, but I want to move away from that today a little bit. So a quick reminder again, on our standard income protection plan, then we offer full cover. So it could be for the whole term, the whole period of the cover. And we do budget income protection plans as well, where you can sort of change the budget for the client a little bit. We can make it a bit cheaper by condensing the claim period that they're allowed to claim for. The term is still the same. So if you agreed a 30-year income protection plan with your client on full income protection, if they fell ill and never went back to work, then we're going to pay that claim for the next 30 years. On a budget income protection plan, then we're going to pay the claim for whatever you shortened that period to, whether it was 12 months, as you can see there, or 24 months. But don't forget, lots of reminders today, if you do go for the budget income protection with your client to fit it into their budget, even though they can only claim for 12 months or 24 months, depending on what you set up, if that is a 30-year plan, they can keep coming back and claiming again and again and again over that 30-year term, even if it's for the same condition. So it just means in one claim period, we can only pay up to that period, the 12 months or the 24 months. But as long as they've gone back to work for 6 months, then we can start paying the claim again. But let's dwell on the features now, because we're talking about families here. So there's a number of different features that do stand out when we're talking about families. Parent and child cover, pay my mortgage, homemaker cover, and then there's actually rehab there as well. So let's go into those in a bit more detail. So Earl, next slide, please. And next one again. Marketing love their break slides, don't they? So, back one. Where am I? Yeah, we can go back. Oh, yeah, that's great. So those different features, let's start with parent and child cover. So this is a unique feature here in the IP market. What it basically means is your client, the policyholder, is taking out income protection. That client, that policyholder, is also a parent in this instance. So on a traditional normal income protection plan, in order for any money to come out of that income protection plan, the policyholder has to be ill and unable to work. But with the LV one, and this is built in, there's no extra cost to this, parent and child cover means that if that parent, that policyholder, your client, if their child is diagnosed with an illness, and there's up to 54 different illnesses, so you can sort of gauge this a little bit like it as if it was a critical illness then, based on the severity. If their child is that seriously ill that it comes under one of those 54 illnesses there, what we're going to do is we're going to give that policyholder, your client, that parent, 6 months worth of their income protection plan. So if they were insured for £1,000 a month on income protection and their child were to become ill under one of those 54 illnesses, then what we're going to do, we're going to give your client £6,000. Now, the great thing about that is, again, if you think about it now, the policyholder, client, parent, they're not ill, but their child is. And giving them that £6,000 could mean that they can take unpaid leave off work to spend time with their child who's ill and know that they're going to cover their bills. It could be actually they're lucky enough that work is going to keep paying them, but it means now they can maybe pay for a hotel nearby to the hospital, perhaps. Whatever it might be that really does help them in the circumstances, they've now got £6,000 that helps them with that. And as I said, £6,000 is based on an example there of £1,000 a month, but it was six times whatever your client is insured for. Next one then, please, Earl. There we go. So the next feature we've got here is pay my mortgage facility. So again, included, no additional cost. Now this is where when a client goes into their claim on an income protection plan, what they could do is they can elect for us to pay all or part of their income protection claim direct to their lender. And why would they want to do that? Why not just put it into their own bank account and then pay it to the lender? Well, the beauty with this actually, if you get them our income protection plan to pay directly to the lender, it gives them benefits with regards to things like universal credit and other benefits as well. So let me show you how that works. Earl, can I have the next slide, please? Okay, so let's look at the specific example now. So in this example here, we have a 35-year-old single mother, 2 young children. She has a mortgage of £1,000 a month. Now, in the first instance there, in the green text, let's assume, first of all, this lady didn't take out income protection. So she's become unwell, unable to work. So doesn't have an income protection plan. So actually what she does, she goes to rely on universal credit. So in this example then, universal credit is going to pay out credit payment. It's going to offer her some council tax support there in this example, 145, and she gets her child benefit coming in as 187. So in that first example there, with no income protection in place, this client then, this single mother, is getting £1,300 coming into that household. Remember, she has a mortgage of £1,000 a month. So that leaves her £300 a month to pay the rest of the bills and for her 2 young children as well. Middle example then. So in this instance then, this lady was savvy enough to take out an income protection plan, speak to one of you advisors, you recommended it, used a risk tool, and she said, yes, let's take out income protection. And actually that was £1,500 a month worth of cover to cover a mortgage and to cover her bills, etc. as well. Now, she's getting £1,500 a month coming in now on an IP claim. That does mean that universal credit is not going to pay out because she's got that income coming in. It also means that the council tax support she's going to get is reduced because, again, she has that £1,500 coming in as an income while she's claiming. Still gets her child benefit. Now, what that means is we've gone from £1,300 going into that household up to £1,700 going into that household. So again, remember, we're paying the mortgage, but that's now £745 coming into that household to pay bills and look after those 2 children. Now, as I said, it's a built-in feature. The client can elect to do it when they take out the claim. It's just a really neat little way of helping with income. If we look at the third example there. So what we're going to do here, the client's elected that she's going to get £500 of her claim and £1,000 going to go direct to a mortgage provider. So that £1,500 is coming out, but we're putting £1,000 straight to the lender. Now, she's getting £500 income, so that does affect her universal credit. But it means she does get some universal credit. So now she's getting £485. She gets that council tax support now because of that low income, that £500 coming in. Still gets a child benefit. So now what we can see, we've gone right the way up to 2,300. So again, remembering that 1,000 was going on a mortgage, that household now has £1,300 a month coming in. So we've gone right the way from £300 not taking out an income protection plan to £700 a month, having an income protection plan, but bringing that money into their own bank account first, to just a little tweak, and us offering that facility where we'll pay the lender directly. That client is now up to £1,300 a month after the mortgage is paid coming into that household. So it's a neat little feature. As I said, if you've got a client who's going into claim, then really do think about actually could use this feature and pay the lender direct and help them out. Next slide, please, Earl. So Homemaker, this is just a little one, we're talking about lots of refreshers and reminders, but again, a bit of a reminder on this one. If you are talking to 2 parents, a couple then, and perhaps one of them is a stay-at-home parent, then don't forget we can still insure that parent as well, that Homemaker. We'll pay up to £1,500 a month. And it just means, again, if you're thinking about that situation, that household, so you've got 2 parents, one is the breadwinner, one stays home and does all the other stuff with the children and looks after the house itself. If it is the homemaker that's ill, then yeah, great, okay, the breadwinner's income isn't affected. However, is it? Because can the breadwinner still go to work to the same scale as they were going to work previously? Because now they're having to take up the slack on the fact that they do need to run that home. They do need to look after the children. They need to look after their spouse as well because they're unwell. So yes, the breadwinner is healthy and isn't making the claim, but the household income really is affected by the homemaker being ill. So again, just think about there when you are talking to a couple where one of them doesn't work and you talk about income protection, don't forget it's not just about the breadwinner, but actually think about the homemaker as well. Next one, please, Earl. And then just a little bit, just to remind yourself, again, a little bit here, and a lot of this happens with most of the income protection policies, but a good reminder when you're talking to clients about protecting income is the rehab support services that we offer. So again, these are just built in within our claims, but there's things like physiotherapy, psychological support, return to work services, lots of ways that we can help that client get back to work a little bit sooner that comes with that income protection plan. Now, a really good example of this one, actually, is if you go onto our website and you have a look at our claim stories, we currently have a video on there from a lady called Jenny Gow. If you're an F1 fan, you might know that name because Jenny is actually a reporter, a pit lane reporter for F1. And actually, a couple of years ago, had a stroke had an income protection plan with ourselves. One of the things that came with that stroke was the fact she wasn't able to speak, which is slightly hindering when what your day-to-day job is being a broadcaster. And what we were able to do with her income protection plan is, yes, we paid the claim, but also what we did is we worked with Jenny to find her a speech therapist. And actually we paid, you know, a fair old sum there, like I think it was something like 30 sessions or something like that we paid for. And through her own determination, Jenny got back to work and is now back on F1 and presenting. And she's in Singapore this week. But that's a really good example there where it wasn't just about the money that comes out, because we were paying the claim, that's fine. But for Jenny, it was about getting back to work, getting back to broadcasting. So what we were able to do was look at that rehab support and actually pay for speech therapy for her and get her back to what she's doing right now. Next slide, please, Earl. And not something we like to talk about, I know, ever, but it is the reality of life. With our income protection plan, we also have death benefit built in. So if you're a policyholder, your client has an income protection plan with us and were to pass away while they've got income protection with us, if it was in the first 4 years of holding that income protection policy, we're going to give them that estate £5,000. And if it was after 4 years that they've had that policy in force, then we're going to give the estate £10,000. So again, you're probably looking at life insurance elsewhere, etc. But it does just mean if the worst did happen and they've got an income protection plan with us, then we're going to give a bit of money to the estate though as well, which again just helps benefit that family. And all of those features, just a reminder again, are all built in within our traditional income protection plan. So they're already there. There is no upsell needed at all here. They're all just the features that are built in. Next one, please, Earl. And next one again, please. So yeah, Georgia touched on family income benefit, and if we're talking about protecting income and families, then it is worth, again, looking back at this one. You know, family income benefit. It does what it says on the tin a little bit there, doesn't it? And again, a reminder to what is it? So it is a type of decreasing term assurance, and it's, you know, we have minimum premiums, etc. But essentially, what we're doing is we're paying out that monthly income instead of paying out a lump sum. But let's not forget that they can commute it to a lump sum if they wanted to. So, Earl, next slide, please. So yeah, just a reminder there, as I said, it still has that pay my mortgage feature on it as well. So again, it helps that universal credit claim. But again, lots of different things there. But it's convert the claim to lump sum is the main one when you think out when you think about family income benefit. Next slide, please, Earl. So again, I know Georgia touched on this a little bit earlier on, but let's not forget where family income benefit can really fit into your conversations with a client, with a family especially, when you're talking all about income. Because yes, it's there if it pays out, it's there to pay for day-to-day bills. So if your policyholder were to pass away, then obviously that income is going to go to the family and pay for those day-to-day bills and keep the roof over their head, etc. as well. It can pay for the rent and mortgage costs. So again, an interesting one here is if you are talking to clients that are renting, then think about it. When we think about life insurance, we do traditionally link that to a mortgage debt, don't we? Because we think, well, that client's just taken out a £200,000 mortgage, therefore we should give them life insurance for £200,000. But if you're talking to a client who's renting, you wouldn't traditionally think about that lump sum perhaps, because there's not that mortgage debt. But again, thinking about family income benefit, then it's a great way for them to relate that to that roof over their heads then and think about, okay, what we're doing is we're actually insuring our rent against one of us perhaps dying. So again, a great one to think about there. Another one to think about, and divorce maintenance payments. So again, if you've got clients in that situation where they're responsible for a maintenance payment from an ex-relationship, then again, to make family income benefit is a great solution there, because it does mean if that parent were to pass away, then it means they know that their commitment for that maintenance payment for their children is going to continue after they've passed away as well. Lots of things you also think about then. We think about future prospects for children, education fees, etc. So again, it's just a way of thinking. Instead of a lump sum, it's commuting it and thinking about more in terms of what are those commitments, those income commitments that you want to keep if you were to pass away. And an interesting one, actually, and more prevalent today, isn't it, is the cost of care. So again, if you've got a client who is responsible for the care of an individual, and if you think about the care home costs now these days, so if that client were to pass away and the individual they care for was to have to go into a home, then it's thinking about how the costs are found from that. And again, a family income plan it could pay out into the estate, and that monthly income paying out into the estate could be what's paying for care for that individual who was previously looked after by your client who's now passed away. So lots of different ways to think about family income benefit. As George alluded to earlier on today, it's not sold anywhere near as much as it should be. But if we think about our market and our protection market, over the last sort of 5 years, income protection especially has really outsold everything else in percentage terms. I think if we look at the last year's stats on that from Swiss Re, overall the protection market went up about 2%, which is great. Yeah, we're selling more protection out to clients, brilliant. But actually income protection went up by 18%. So more and more clients are appreciating that need to protect their income. So let's not forget, family income benefit is part of that family as well. Next slide, please. Oh, our next one again. Oh, our next one again, because they've got another break slide. So there we go. Right. So what I wanted to just finish on today, as we're talking about, I know we talk about income and everything else and how that relates to family. But I just want to hover for a little bit here and talk about what we call doctor services. But essentially, these are the added services that come with any protection plan from LV. And actually, a lot of these added services would come with any protection plan that you talk to clients over. But let's not forget with these features how important they can be to a family. Now, the great thing with added services, just for a moment here, is to think about, yes, you can weave into your sales conversation with your client, if you like. You know, when you're talking about recommendation, these additional services to them, and they can be part of that conversation. But let's not forget, they're also great that when you're talking to a client about their policy going on risk, so let's say they've gone through underwriting, etc., and there's been a bit of a delay in getting them on risk, it's a great reminder when you're telling them that the policy is going to go on risk, of saying, right, you go on risk today, your policy's in force today, your direct debit's going to start, but actually don't forget you've got all these great things you can use right now, day one. So this isn't about a claim and the severity of a claim, this is about everyday things you can use with your protection policy. And these are also great things to go back to if you're doing a review with your client. So if you're sat down with a client because they're coming back to you about perhaps a remortgage or a product transfer, then looking back, what were the additional services that came with that protection policy? That's a great starter conversation about protection. Because it could be that your client 2 years ago took out an LV protection policy. Now you're sitting down, you're talking to them about their remortgage. And what you want to do is actually you want to just go back to the protection conversation. And you want to go back and look at some of those gaps, perhaps, where they felt they couldn't quite afford it last time. Perhaps they didn't take out all the cover you recommended, and you want to revisit that conversation with them. This is a great way of starting that protection conversation, because you can say, look, we arranged that protection with LV 2 years ago. Just as a reminder, that policy actually came with access to a private GP. It came with a physio service. Have you used that at all? And the client says, no, I'd completely forgotten. So straight away, you're on a bit of a winner there, aren't you? Because you're just reminding the client that the protection policy arranged for them last time, whilst they've been well enough, they've not had to claim on it, there was great features there they hadn't used. And that helps you then ease into that protection conversation when you're doing that review. So first of all, it's just reminding them what they had and how they used it. So as a reminder of that, then, I said this client took out this policy 2 years ago, perhaps. And yeah, what they could be doing is accessing a 24/7 private GP service. So with all our protection policies, your client is able to access through video or audio, through Square Health, which is our partner we work with here, they can access a private GP. So within normally about 2 hours, they can be connected to a GP somewhere in the UK who will talk through them what their concerns are and can also prescribe a prescription for them if needed as well. And that's not just for the client, we're talking about families here. This is for the client and children up to the age of 16 as well. And what you can also do, if your client's got this in place, they can access it if they're abroad. So if the client's on holiday and they're feeling unwell and they just want to check in what it could be, perhaps find out whether they go and buy something over the counter at a pharmacy in whatever country they're in, then they can still access the private GP service as well. Great one, especially when you think about younger children. Concerns you would have as a parent if you were abroad and your child was feeling unwell. And it could be a pharmacy down the road in whatever country you're in. But again, they can access the private GP and get that guidance. And then as things change in people's lives, then it might be that the client has wanted to use the mental health support or perhaps the physio support. And these are just basically, again, online plans that they can work with the service there. I think it's up to 6 physiotherapy sessions, for instance, they can have through the plan as well. And the last one in the blue boxes in the corner there, this isn't so much your everyday thing that a client would use, but it's a really important one, because if your client has a diagnosis they want to get a second opinion on, then doctor services also supports them there as well. So even if your client has, let's say they've got life insurance with us, they would have LV's doctor services, and they have a cancer diagnosis. Now, thankfully, they're not well enough that they're going to be thinking about their life insurance plan with us. But actually what it means is, because they've got life insurance with us, even though they're not going to claim on that plan because they've had this cancer diagnosis, they can go and get a second opinion on that using their doctor services under their life plan. So even if they're not insured with us for critical illness, for instance, or whatever else they may be coming to us for claim for, they can still use that expert second opinion. So not so much an everyday thing, but if we think about the other ones there, definitely these are everyday services the client could be using, and especially the private GP one. So I said, when you're going back to your client and you're doing reviews, or you're talking to your client about them going on risk, to give them that reminder about the great stuff that comes with their policy. Because these aren't just sort of bells, whistles, shiny things that come with a policy, why you should talk about LV instead of somebody else. For you and your business, this is a great way of the client remembering that they've got a direct debit coming out each month for a protection policy. And yes, they've been healthy enough, they've not had to claim, they've not had to use the expert second opinion, but what they have done is they have used the private GP service. So it makes that direct debit tangible for their protection policy, which helps you and your business because it means they're more likely to keep that direct debit in force. Next one, please, Earl. And then last little bit on that, I'll just touch on one side, legal advice line there. So because we are a mutual, we do some extra little benefits as well. And one of those, when we talk about everyday services the client could use from their protection policy, is we have a legal advice line. Again, 24/7, lots of different things the clients could use it for. So it could be that next door's conifers are growing a bit high and they want to find out whether they can cut them down. It might be there's a planning development going down the road and they want to find out what they can do about it. Lots of different things. But again, everyday life things that your client could be using their protection policy for. In this instance there, it is touching with a legal advice line. Next one, please, Earl. And that brings me to a bit of a close. So 3 main takeaways for me, I guess, from the session that I've gone through today is think about income protection and think about when you're talking to families, what are the features and the benefits you can draw out that really gets that family to buy into this income protection recommendation you're going to give them. So it's not just about the individual. And remember, you know, unfortunately, there are lots of them out there. When you're talking to maybe perhaps the main breadwinner, there might be that attitude of, it won't happen to me. But it could very well happen to them. We've got risk tools that prove it, but let's get them thinking about who's dependent on their income and think about those people and how that income protection plan benefits them as well. Family income benefit, definitely. We've talked about that, how it benefits families, so do think about that one. And as I said, when we talk about LV's doctor services, those added services, don't just think about, oh, they're just added things that come with the policy, little shiny things. Really do think about how they can fit in to your recommendation, to your reviews, to talk to the client about how and when they go on risk, and how that weaves in and how you get your client to buy into the protection policy on a regular basis, rather than it being a direct debit that perhaps if they stay healthy, they get thinking about, do I need this protection cover? If they're using it for the private GP service, it's front of mind. They're not questioning that direct debit. They're not questioning your advice. And that is it from me. So thank you again for your time today. Apologies that we had a few technical issues there right at the start. Don't forget, lots of ways we can help and support you. You can reach out to me by all means, but we also have your regional account managers on hand as well. But if you don't know who that is, you can always contact me or contact me through TMA, and then obviously we'll pick that up as well. Thank you.
Thank you. Wonderful. So technology 0, humans 1. We done it. Well done. We're glad that we were able to get you back on there, Carl, because it's a really good presentation. Nice way to conclude our session this morning. I won't summarize what you've done. You've said it well enough, better than me. But you know, really nice feature you mentioned to do with Pay My Mortgage Facility, I think it was. So really good tip. Just makes the difference, doesn't it, with the skillful advice that our advisors can give over somebody else to help somebody get the most out of a situation. I thought that was really, really good insight.
Yeah, absolutely. Absolutely. And as I said, whilst income protection is growing, I said that it is continuing to grow every year. I think I would give all of you credit that have come along today on the basis that not everybody talks about income protection. You know, it's still not sold anywhere near in the levels of critical illness and term assurance. It's not sold online, so it is something that is advised on. So yeah, for all the advisors joining today, talk about protecting income, because it will set you aside from some of the people on your high street alongside you who are not talking about it. So it's a great way for standing out, to talk about protecting income.
Well, some great direction to conclude with. Thank you very much, Carl. And it just leaves us now here at TMA to say thank you to all of our presenters. Some have left us now, but thank you to them. And thank you to all of you who support TMA with these events. Of course, these events are nothing if you don't attend them. So we really appreciate you taking the time out of your busy schedules to do that. So thank you. And again, just a reminder, the presentations will be available through the YouTube channel, just as long as we get the acceptance from all the presenters, which I'm sure will be fine to do that. And that will be available as soon as possible. And again, your CPD certificates will be sent to you in the next 2 to 3 days. And it will be sent to the email address that you registered to this event using. And that's it. So thank you very much. Please, again, just a reminder to go online, tmaclub.com, get yourself registered for our annual conference, 27th of November. We look forward to seeing as much as you there as possible. Thank you, Carl. Again, thank you very much. Have a wonderful day, everybody.
Thank you all.
And we'll see you soon. Take care.